monetary policy to become less restrictive. A strong labor market and macroeconomy offer the chance to execute these policy decisions without oppressive urgency.
That's next. You're watching Bloomberg Surveillance.
In a very, very short period of time. Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from. Just seems to me like such a amazing transformation across the globe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Debate about working from the office versus home here around the table at Surveillance. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern, Lisa Abramowitz, Manus Cranny, Jonathan Farrell will be back on Tuesday. Right now we're looking at a market that continues to get a lift from the sense that companies are immune to some of the pressures that we see elsewhere, or maybe just that NVIDIA keeps on NVIDIAing, although it is down today after some people were raising some questions. 56 on the S&P futures. Eurodollar doing nothing but euro gaining out. It's sort of like a horse race that nobody wants to watch. 10-year yields up almost 3 basis points, 426. And crude lower after getting to some of the highest levels this year, down 0.8% Under surveillance this morning, Fed President Bostic saying there's no rush.
We will likely soon contemplate the appropriate time for monetary policy to become less restrictive. Right now, a strong labor market and macroeconomy offer the chance to execute these policy decisions without oppressive urgency. All things considered, the U.S. economy is in a good spot, even an enviable spot compared to other major economies.
And that was the dove on the bench. Here's the latest PPI due at 8:30 a.m. following hotter than expected CPI earlier this week and weaker than anticipated retail sales. Ian Shepherdson of Pantheon Macroeconomics writing, quote, "Our mapping of the retail sales data on the personal spending numbers suggests that real consumption probably fell slightly in January. It is far too soon to say that consumer spending is now on course for a sharp slowdown in the first quarter." Ian Shepherdson joins us now. Ian, how do you parse the difference between a slowdown and a sharp deceleration? What's the difference and how does it matter?
Yeah, it's got to be sustained. That's the first thing, especially when you're looking at data from the middle of the winter, because it's quite probable that some of that weakness in January retail sales was weather-related. So some of it probably will rebound in February. Some of it might be lost permanently. At this point, we just don't know. I'd also just remind everybody that the U.S. retail sales numbers get revised even when the weather's fine. So this is the first stab at those data. They'll be revised potentially quite substantially. So I always kind of think that we should just take a deep breath whenever we see something that's really surprising, and this applies to the CPI numbers as well this week. You know, take a deep breath. wait and see what happens the following month. Think about these potential special factors which might be at work, and don't dive into a premature conclusion, because you might then just find yourself having to reverse that position very quickly within a few weeks. It's always a good idea to take a breath at these numbers.
Ian, good morning. Good to see you again. That is the issue for the Fed, though, isn't it? There's words, there's language that they're using. Victory is not at hand. We want more confidence. We want more clarity. We want more ammunition to give us the verification for cutting rates. They don't want a 90s redux, which is where they went through cutting rates, only having to raise them again. What is it that will give them the confidence to pull the trigger?
Well, they've pretty clearly told us that they're not going to pull the trigger in March. So by the time May, June rolls around, we'll have a lot more data on everything. We'll know whether that drop in retail sales in January was real or a statistical artifact or a weather effect. We'll also have a much better idea about payrolls, because remember, we had a big upside surprise in January and upward revisions to November, December. So it looks as though the payroll numbers have strengthened. But if you look at the forward-looking stuff, you can also make the case that by the time May, June rolls around, they'll have weakened again. And given that uncertainty, plus the fact that this is a very cautious Fed anyway, after the whole transitory fiasco on inflation, they've told us that they want to see a lot more data on everything. It's not just that they want to see the core PCE printing at 2% annualized every quarter. It did that in Q3 and Q4 last year, so already there on that, but they want to see it do it again in Q1. And they want to see some evidence, I think, that the long-awaited softening in the labour market, at least at the margin, is beginning to emerge, whereas the very latest data from the labour market kind of point in the opposite direction. So what do you do as a policymaker who's cautious and nervous at this point? Well, you just tell everybody that you're going to wait. And so that's exactly what they're going to do. And that's what Bostic said again yesterday. Yeah, well, maybe the Europeans maybe have less time to wait than the Americans. In this cutting cycle, it's interesting when you look at some of the stories that we've got this morning. Jupiter Fund boost their treasury bets to a record. They're going for a hard landing and 400 basis points of cuts. 400 basis points of cuts. They've also run the analytics in the cutting cycles, and that's why I'm curious to get your view. The typical cutting cycle is somewhere between 350 to 375 basis points. Everything that we look at so far does not suggest that that's the kind of scale of cutting cycle that we're going to get, because we are in a fundamentally different economy to the 1990s. So with that trajectory over the next 2 years, are we going to make anything like 350 basis point cuts without some dramatic incident to take us there? Well, it's certainly true if you look at Fed history over previous cycles. That is roughly by how much they cut, but of course they tend to be cutting either in response to a shock like the GFC or COVID, or a major economic cyclical event which drives up the unemployment rate and pulls down inflation quite aggressively. So in the absence of all of those things, we do have a different position that the Fed normally faces when they're starting to think about cutting rates. What we've got instead is inflation heading rapidly back towards their target at a time when the unemployment rate is still very low. So that would certainly suggest at the beginning that they proceed cautiously and slowly, and that they don't dive into the rate cuts in the way that you might normally expect. But I don't think we should then rule out the possibility that later on they have to go faster, because some of the leading indicators on things like layoff announcements and small business hiring intentions and businesses' capital spending plans really do now look quite weak. Not yet in the hard data, but certainly in the leading indicators. So if that materializes over the course of the spring and the summer, that would give the Fed the green light to move faster, and it would bring that sort of not necessarily hard landing, but a bit worse than the sort of base case, everything will be all right landing coming into view. So again, this argues for the Fed to retain optionality in terms of flexibility, of timing, and of scale of the rate cuts. But I think, as we've seen so many times over the last few years, so many impossible things have happened, so many things that we thought were certain to happen haven't happened. We all have to keep a very open mind about this cycle, because there's no real parallel for it in any previous historical episodes. So I'm certainly not saying that there's no chance the Fed cuts by 400 basis points in this cycle, but I certainly think that at the beginning, they're going to be very careful not to send the signal that that's what they expect. 2 years down the road, who knows? I mean, I think we all have to be quite humble here. With respect to the layoffs, are we seeing the end of labor hoarding? That's a good question. I'm sure there was a lot of labour hoarding in 22, 23, because businesses just found it so difficult to rehire people after the pandemic. That's got much easier now because participation, especially among younger people, is now at record highs. And I do think that now that sort of intensity of, it was so difficult to get these people, I'm not going to let them go, I do think that's beginning to fade a bit at the margins now. And I think there's a very good chance that as this year progresses and we see businesses' margins coming under a bit of pressure as consumption maybe softens a little bit and they just have to fight a bit harder to maintain their market share. To maintain net earnings in that environment, you need to think really hard about your labor costs. So, yes, I think there's quite a good chance, and we're seeing it in some of the leading indicators, that actually layoffs are picking up. And that would, to me, be consistent with this whole story that businesses are finally realizing, look, if I let these people go and then I need to hire them back, I'll be able to do it. Whereas, 2 years ago, they were terrified. If I let this guy go, I'll never get him back. It's a different environment, and I think it is beginning to impinge on their actual behavior.
Ian Shepherdson of Pantheon Macroeconomics, thank you. It was just notable to me to see all these layoff announcements, and we could say, why haven't they showed up in the numbers? But the fact that a lot of these companies feel the freedom to make these cuts to people is a shift, Manus, from what we saw last year and the year before.
It really is, and that's presumably going to pass through then into wages. It depends whether it's technology rate cuts, Lisa, based on transferring into AI, or whether it's just real job cuts. Nike cutting 2% of the workforce, Cisco cutting 5% of the workforce this week. So you may say they're incremental. Technology has dropped, 32,000 jobs approximately, and that was the last count. So it's probably gone up since then so far this year. So it is about an ability to be a little bit more punchy with the workforce.
I think it's also important to note where these layoffs coming from. Like in UPS, it was people not delivering the packages, but in the back end, in the offices. But to your point, Lisa, the data is so noisy and complicated, because why is it not showing up?
It's a great question, and maybe it's having to do also with the continuing claims actually rising some of the higher levels. At least maybe they're not getting rehired as much. Coming up next, we're going to be speaking with Sarah Hunt of Alpine Saxon Woods, Greg Valliere of AGF Investments, and Kelsey Barrow of JP Morgan Asset Management. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. Mm-hmm. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
We'll start to see some weakness in consumers, really on the margins.
There could be some fairly significant implications for margins later this year if you don't see CPI continue to fade.
We have seen the highs in inflation. We're in a disinflationary environment.
The issue for consumers is that companies haven't really dropped prices.
The consumer is a little bit more stressed than what they were before, but as long as employment's strong, you know, I think there's a resiliency that sits within all of the consumers.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes until key economic data, PPI coming out to round out the week of a modeled kind of view on the U.S. economy. We're talking about CPI coming in hotter than expected and retail sales falling. From New York City for our audience worldwide, welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern here, Manus Cranny. I'm Lisa Abramowitz. Jonathan Farrell is off for the remainder of the week, which is just the rest of today. When we take a look at what's going on in markets, in the economy this week, I have to say, Manus, the economy is not the market is not the economy, and what it looks like is the equity market is flying on the heels of NVIDIA, and the economy maybe is showing some signs of cracks.
Yeah, I mean, definitely those retail sales, and I think each guest has consistently said go a little bit below the hood, and the retail sales are perhaps a little bit more worrying than we all presumed. The market just passed it off. It passed off a hot CPI. It passed off a weak retail sales. We put in 11 record highs so far in 2024, Lisa, and if it continues on this kind of velocity, you're talking about a year like 1995, which was excellent, but then, of course, the Fed spoiled the party. They had to raise rates after cutting rates, and that is what Bostic is worried about. We haven't clearly got victory in hand, and so these are going to be delayed rate cuts until there's a real sense of confidence.
There's a question, though, about how much that's really going to matter for the NVIDIA-driven rally, that it's a really narrow breadth, and that, yes, there flows into the equity market, but it flows into the AI story. This is a reason why people are watching for next Wednesday, NVIDIA reporting earnings, kind of a key moment, not just for big tech, but also for broader equity markets in the U.S.
Bank of America, the flow showed it's almost like a Bible, isn't it? But it's a very robust indicator. And Michael Hartnett and the team say, look, the top 5 stocks account for 75% of this year's rally, and that breadth in the equity market is the worst since 2009, March 2009. That should send a hot red flag to every asset manager in the world. But what can you do? You don't want to be left. It is weaponized form. You don't want to be left off that boat.
Yeah.
I'm even part of it. Deploy.
Well, there is this question about how much that's going to support things, as there are plenty of other risks, whether it's election risk, whether it's geopolitical risk. And Marie, I do want to get back to the story that we were talking about earlier that just broke. Interfax reporting that Russian opposition leader Alexei Navalny died in prison. It has great implications given the fact that he was the loudest voice against Vladimir Putin. I know your phone's blowing up. What's the sense right now?
Well, the spokesperson came out and said they have not been able to confirm it, so his lawyer is on the way to the prison. But Interfax is confirming this. They're saying, according to Russian media, that he fell sick during a walk and medical staff were unable to revive him. There's going to be lots of questions about did he actually die of natural causes? Remember, only just a few years ago, he barely added this nerve agent attack, which most Western leaders blame this was at the hands of the Kremlin. What happens next is going to be very interesting. Will people in Russia actually come out and potentially protest what has happened to Alexei Navalny? This is an individual who he's ran against Putin. He ran for mayor of Moscow. And then, of course, there's going to be this global condemnation. But what else can they do to Russia? all the sanctions and penalties have been laid.
It's going to be curious, though, how it's colored given some of the tense debate in Washington, D.C. We'll be getting more on that in just a bit. Right now in markets, you can see just more of the same. A little bit of a lift to equities, 50.56. Euro dollar, well, again, it's the horse race that just keeps around 107.77 at the moment, and we can see yields up, just pushing a little bit higher through the session, 426. The interesting one is crude, off some of the highs of the year as people look to some of the tensions maybe resolving. I can't keep up with what the narrative is that's driving oil on any given day, so I'm not going to pretend. Coming up, Sarah Hunt of Alpine Saxon Woods and the tech-fueled equity rally. Greg Valliere of AGF Investments as the House rules out another temporary spending bill. And Kelsey Barrow of JP Morgan Asset Management as the economic data jolts the bond market. We begin with our top story, the AI-fueled rally in stocks driving the S&P 500 towards 6 straight weeks of gains. NVIDIA at the forefront, as we've been talking about extensively. Sarah Hunt of Alpine Saxon Woods saying all eyes are on its earnings report next week, adding any faltering by the current poster child would, we believe, be a problem for equity markets, especially as investors start to push rate cuts further into 2024. Sarah Hunt, I am very pleased to say, joins us now. Sarah, can you give us a sense of why NVIDIA is driving the market? Why maybe if NVIDIA misses, others couldn't necessarily rise up and take over?
Well, I think that the good news was that Microsoft came out with good numbers and showed that some of the AI was actually fueling some of their earnings, right? This is the big question. Yes, this is great technology. Can you monetize it? NVIDIA is the poster child for that because it's the demand for those chips that's fueling everybody's usage of all of this. If they have any kind of wobble, that anyone can say, well, maybe this isn't as fast and as quick as we thought it was going to be. I think that the whole story comes into question. And that whole story was, I think, instrumental in helping equity markets through the fall of last year when the rates looked like they were going higher and they were going to stay higher. And then all of a sudden the market had something to hang its hat on, which was AI is coming, productivity is coming. We have something to look forward to because equity markets like a good story and they want to look forward to something. If it looks like that story has any kind of weakness, I think it's going to be a problem.
We saw a $200 billion market capitalization rally in one day for Meta. What kind of downside are you potentially bracing for with NVIDIA's earnings?
Well, I think the thing is that, you know, people keep making parallels to 1999 and 2000 with the dot-com era and everything else. This time you really have earnings to back it up. But if you don't see that earnings growth, or the potential is, you know what, this year is going to flatten out a little bit, people are expecting some huge numbers and some huge growth out of these. The question is really going to be if you don't get it. Does the stock drop a lot? I don't know. It's really going to be what am I forward earning? What am I looking forward to? And if that looks like that's going to slow down, I think that everything in this space has got a little bit of room to come down because everything has just moved so quickly and so high.
There is quite a frenzy and almost mania to the sort of the daily obsession. I think, as you said, Lisa, people were just waking up and they just check their NVIDIA price. And to the point on the flow show from Bank of America, I mean, you actively look at markets every day and you deploy. What conversation do you have about concentration risk and breadth? How do you deal with that?
Well, I think that when you're constructing portfolios for clients, you want to make sure, I mean, it's very difficult when the market is this concentrated, right? Because no one's going to put a portfolio together that looks like the top of the S&P, because those 5 stocks are something like 30% of it. Yeah. That's very unusual. So you talk to people and you explain to them that, yes, you have some participation in your portfolio, but if you get a change in rotation or a change in leadership, or you finally see that market broaden out like everyone is looking for it to do, or you get some sort of slip up like in NVIDIA or earnings, you don't want to be 100% technology, because then you're going to feel that downdraft like you felt it in 2022. You want to be making sure that you have enough other things in the portfolio that are looking at different parts of the economy so that, yes, you have to have some tech because you can't be completely unexposed, but you can't be as exposed as the S&P or the Qs are.
So where are those other parts in the portfolio then that warrant, is it dividend flow? Is it sort of a poor man? I think I had somebody actually say to me, get a poor man's NVIDIA. That's a whole other story. But where are those other portions in the portfolio that you should be paying attention to? Consumer cyclicals, the consumer looks a little bit faltering at the moment. You've got oil, which is sort of range bound, but paying out big dividends. So where are the alternatives?
Well, you've got places where you've got really good cash flow and really good growth. You've got some industrials where that's happening. I know that energy has been a back and forth discussion, but there's still a lot of cash flow that's going on there.
There's a heck of a lot of buybacks in that, isn't there?
So you got a lot of buybacks, you've got a lot of dividends there. We look at cash flows. Cash flows are very important. You look at some of the places in the industrial space like HVAC, right? So Carrier and Trane and the companies that are looking forward to to a long period of growth because you're changing out how everyone is looking at their own HVAC systems. Everyone's looking for clean air, especially post the pandemic, right? So you've got places where there is going to be growth that are not just stuck to technology, but have a technology component, which is, cleaner air.
All I can say is that I'm having HVAC issues right now, so this is going close to my heart right now. I'm curious, though, just to go to the broader economy and how you frame it out into an equity view, given the fact that we were just talking about some of the job cuts that we're seeing announced. How you view this, given that it's not showing up in some of the numbers that we're seeing in terms of unemployment?
Well, it reminds me of the job cuts that we started to see. When Facebook finally said, you know what we've got to do, Meta, we've got to cut our forces, we have to stop spending, we have to do this. A lot of those job cuts didn't show up because they were in the higher echelons. And the question is that what's going on right now? Or is there some combination of people taking second jobs because the jobs numbers look so strong? It is hard to parse out exactly what's happening, but you can certainly see that there is some stress on the low-end consumer. You're seeing delinquencies come up on credit cards. You're seeing auto loan delinquencies come up. There is stress in the low-end consumer, but right now the higher-end consumer is still consuming, and so therefore you don't see that balance isn't there yet quite. But I think that there's some real stress under the hood of the system, and I think that's where you have some real tension going forward.
This is what a viewer wrote in. The fact that if you're on the higher end of a pay scale, you actually cannot qualify for some of these unemployment benefits. So in that sense, is it those that are on the lower end of the socioeconomic scale in the United States that are dealing with inflation but still have their jobs, and those on the higher end potentially can deal with and withstand inflation but are at risk of losing their job?
There's a near-term series of issues of having your job and being able to deal with inflation, because I talk to people all the time who are, who are not in the higher end, who are saying, look, it doesn't matter that inflation isn't going high as fast. The price levels are much higher than they used to be, and they're not coming down. So yes, you might still have your job, but that spending is going to be tricky as you start to move towards, we're really fully out of COVID savings. Whatever raise I got isn't covering the fact that I'm going to start substituting down. Look at Kraft Heinz. Look at some of the earnings in the space where people are going, I'm going to trade to cheaper ingredients because it's too expensive to keep doing what I'm doing. And yes, to the high end, people are still spending, but if they're out of a job long enough.
Do you buy into the administration's idea that there's greedflation, corporate gouging, and what companies are doing is shrinkflation, and that they should actually be passing it on to the consumer?
I think shrinkflation has been going on for years. I mean, when was a pound of coffee 12 ounces? When did that happen? That wasn't in the last 6 months. That happened like 5 years ago. So I think that there's always been that sort of a movement. It's been much more obvious now because ingredients have gotten so much more expensive. Do people take advantage in small ways? Absolutely. But is that the reason? I don't think that's the reason. The reason is that price levels are just not coming down, and they're not coming down all along the food chain. So yes, there are periods of time when people can prosper from that, but it doesn't last.
One of the narratives from the CEOs that we've spoken to so far in this quarter has been the ability to raise prices. Hermes, I know that Lisa is immune to the price rises at Hermes.
Thanks. Carry on. It's true.
But what we are seeing is somebody like Hermes is able to really premium price. But the rest aren't. You're looking at booze companies that are having trouble in terms of volume at the lower end, and Heineken. I caught up with the Moët Hennessy CEO. He said, I can't squeeze prices much higher than here. It's going to be a very different environment in prices. Now, the Fed are going to like to hear that. But in terms of corporate earnings, is that going to be, I don't know what the right word is, whether it's a headwind or a cap.
It's a margin squeeze. Right? And in the end, a margin squeeze is part of a problem for earnings, which is for a while you had this world where, yes, inflation was going higher, but people could push price. Labor contracts hadn't caught up yet. So you did have a larger margin ability, an ability to get a larger margin. As labor costs start coming up, as the ability to push price starts coming down, that's going to be the question, because we're all baking in a large earnings growth for 2024. And are we going to get it? And the question is, I don't know. Can technology save us? Because their earnings were so much better. I don't know. I don't think we know yet, and I think that's one of the biggest problems that's going on.
Sarah Hunt of Alpine Saxon Woods, you're going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is Yahaira Hakis with the Bloomberg Brief. Yahaira.
Hi, Lisa. Russian opposition leader Alexei Navalny has died in a prison camp. Interfax reports the Russian prison service is saying Navalny, quote, felt unwell after a walk, almost immediately losing consciousness. Navalny was one of Vladimir Putin's most vocal critics and was serving a lengthy prison service for charges including extremism. Shoppers in the UK picked up their spending. Retail sales in Great Britain jumped by the most in almost 3 years. A boost to an economy that just last year dipped into recession. Sales jumped 3.4% in January, more than double what economists expected. The latest figures prompting traders to trim bets on how many rate cuts the BOE will deliver this year. Novartis says it's working on the next generation of obesity drugs after missing the first wave of weight loss treatments. The lucrative market has been dominated by competitors Novo Nordisk and Eli Lilly. The CEO telling David Rubenstein on peer-to-peer conversation what's on the horizon for the company.
We're working on really the next wave of medicines because I think these GLP-1 medicines that you're talking about are very well serviced by the current companies. But we think there's opportunity to improve on them, and we hope it's very early stage within Novartis, but can we come up with drugs to better preserve muscle, are maybe easier to take and more infrequently taken?
The full interview will air on March 6th. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, a looming government shutdown deadline.
You're not going to get another continuing resolution out of our conference in Congress. When we come back, the key is going to be what are the packages that are put on the floor.
We get to talk about that coming up next. This is Bloomberg.
Was going to keep Rain World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg Surveillance on a Friday, which we are all happy about after muddled data. Right now, we are looking at markets that are lifting after a week of record highs, albeit with one hiccup. Right now, you're seeing yields just marginally higher. Euro dollar not doing much, but crude markedly lower as people take a look at maybe supply, maybe risk that they see as diminished. Really, there are a lot of crosswinds there. It has been a curiosity. Under surveillance this morning, yes, we're talking about this, a looming government shutdown deadline.
You're not going to get another continuing resolution out of our conference in Congress. The last one was difficult. That was done because our speaker recognized that there just wasn't enough physical time to process all the bills once the House and the Senate had agreed on the top line number. When we come back, The key is going to be what are the packages that are put on the floor. We should be there before the first deadline of March 1st.
And probably everyone heard blah, 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 because how many times have we heard this before? Here's the latest. 2 weeks out from the next deadline to avoid a government shutdown, House Republicans ruling out the chance of another temporary spending bill. Greg Valliere of AGF Investments saying everything's still on the table, writing very few GOP lawmakers want a shutdown. The reputation of this Congress is in tatters, so they're exploring all options, including another extension, perhaps for the rest of the year, or a deal that would require votes from Democrats. Greg Valliere, I'm very pleased to say, joins us now. Greg, do you like talking about this?
Oh, yeah, it's my favorite thing to do, Lisa, talk about a possible shutdown. It's how many years are we going to fall for this and fall for the hype and have it not happen?
Well, that's the reason why I ask. You know, I mean, it's your job to cover all of these things. And I wonder, you know, we sort of hear noise, and yet other people say that fiscal stimulus has been behind a lot of the economic strength that we continue to see. So how much can that fiscal support continue to unleash into the economy if you do have this joy of funding that we get to talk about all the time?
Yeah, it's a factor. It's a factor for the economy and obviously for government workers. I would argue that the biggest angle here is the credit rating agencies, Fitch, S&P, which already have downgraded U.S. debt, and they do it again. And they have stated that it's not entirely because of our deficit, which is a mere $34 trillion. It's also because the whole process in Congress is so dysfunctional. It's a negative story for the markets.
So do you think they could actually get these appropriation bills done in the 3 days when they come back from recess?
Yeah, I'd say that's fairly unlikely that they could do it in 3 days. And you know, there's an angle here. If they don't, and it drags well into April, then there are some issues that are going to get neglected. Like if they actually change the child tax credit, well, it's going to be complicated if they do it after April 15th, the tax filing deadline. But no, I think this is going to drag on. I don't rule out, by the way, getting a bill for the rest of the year, doing something through September 30th. It's not totally out of the question.
So when Tom Emmer says, though, there's going to be no continuing resolution, is this just, okay, they say that, but then they backtrack? Or do you think that there could potentially actually be a government shutdown?
I think a government shutdown is unlikely. It's been such a chaotic last few months for this House. Do they want to be humiliated further? Mike Johnson has lost his halo. I think he does not need that kind of publicity. So no, but again, I do think that some kind of continuing resolution for the entire rest of the year is on the table.
I want to ask you about what's going on internationally. Overnight, CBS News poll says that if NATO countries attacked by Russia, should the U.S. defend them? 75% of Americans say yes. It seems like the former president is out of step with the American population when it comes to NATO. And then we just have this news that Alexei Navalny has died in prison. How much harder does it make the Republicans to say that they don't want to go defend NATO countries, especially at the helm of a Russia with Vladimir Putin?
Very good point. I think that the last thing the Republicans need is a perception that they're soft on Russia, that they're coddling Russia. And I personally think this was not a good week for Trump because of what he said about NATO. Like, oh, sure, you know, let's have Russia invade a NATO country and we're not going to do a thing just to punish them. That was just absurd. And I think a lot of Americans have heard enough of this and are disappointed. I would note, though, I took a look this morning at all of the key state polls, Trump versus Haley. In most of these states, Trump is ahead by 50, 60, 70 points against Haley. So he obviously has a strong base, but I think saying something like this about NATO is not a plus for him.
In terms of how that plays out, I mean, at the election, will Americans really focus on international multilateral organizations when it comes to making the decision about their president or their party?
I think two things will dominate. Number one is abortion. I think especially in House races that often pivot on issues like this, there's a strong feeling the Republicans are too strident. And the other thing is immigration. I thought the other big political story this week came out of Long Island, where the winning Democrat said, you know, we can't do nothing, as the Republicans are now suggesting. And maybe inflation plays in. We didn't get a good inflation number, but I think that immigration and more than anything else is going to be an issue, and abortion.
Greg Valliere of AGF Investments, thank you so much, as always, for breaking it down. Now breaking down politics on Long Island is Sarah Hunt. I'm just kidding. Don't worry, I'm not going to have you do that. I do, though, want to talk about some of both the dysfunction that people talk about in D.C., but also the fiscal stimulus that you expect to get passed and how that's sort of affecting where you're investing. How much can you get conviction in investing, say, in the military complex, in industrials, in anticipation of some of the fiscal money?
Well, I think that, you know, we've talked about infrastructure a million times. Do we really ever get to fund some of that infrastructure? I think that it's clear that there's been more government spending than people anticipated originally, even a year ago, which is part of the reason why this whole liquidity and whether or not we have tight financial conditions or easy financial conditions comes into play, because you've got a lot more government spending consistently than we thought we would. And that deficit is building up, and no one's talking about what that means, and no one's talking about where that interest payments are coming from. You look at all the auctions all the time. The auctions have been better now. So what does that mean? Is it just that, again, globally, we're the least bad place to put your money, or because we have that reserve currency, we can keep going? That's part of the issue going forward.
Next week, there is a $16 billion auction of 20-year notes, just in case anyone's wondering. I am curious, though, how you use that to frame out the stock-bond correlation and whether bonds will continue to act as they did before this period as ballasts to potential risk.
Well, I think the bond question right now is very tricky, because you've got the Fed. We know we're going to eventually get some easing. How much easing we're going to get, we're not sure. On the other hand, you had 15 or 20 years where you had zero interest rates, right? So you finally have some kind of interest rates in the 10 years. So you've got some room to put some balance in a portfolio. But then you also have had, you know, prior to that zero interest rate, a long period of time where people made money on bonds on the pricing of bonds. So it's getting people back to understanding what you're getting is a coupon and a guarantee of your money back. And if things get more volatile, that's a good thing to have.
Sarah Hunt, always wonderful to see you. Thank you so much for being with us. Sarah Hunt of Alpine Saxon Woods. Coming up, Russian opposition leader Alexei Navalny has died in a prison camp. This according to Interfax. We'll have the latest next. This is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
About an hour until we get the latest in a slew of rather confusing economic data points. PPI coming up at 8:30 a.m. Eastern. Right now in markets, the data has mattered for a hot second, and then it didn't anymore with hotter than expected CPI cratering at least the bond and certain aspects of the stock market earlier this week, and then things reprised back to their gains and record highs. S&P futures back from some of the earlier highs, up just now about 0.1%. NASDAQ up about 0.5%. Russell 2000 down 0.2%. And again, this correlates over into the bond market where you see yields climbing higher. That correlation with the Russell 2000, Menace, has just been lockstep in terms of higher yields, lower price on small caps.
Even more so for the small caps, and everybody has been sort of saying maybe it's time for breadth, time to reach into value relative to growth. I mean, it's the trade of pain. It's a bit like being long yen. 2024, it was the year that was supposed to be yen rallying, and you got slapped in the face with that. Well, it's supposed to be the year for breadth. Well, 5 stocks, look at the flow show, 5 stocks from Bank of America have delivered 75% of the S&P 500's return. And if NVIDIA does not deliver, as we said, for the past 2 days, it's going to be a shock. And that's what Sarah just said just a moment ago. If NVIDIA does not deliver, it's going to be a Damascene moment for the equity market.
Which is a reason why people are perhaps not trading too much. We are seeing yields marginally higher, close to the highs of the year, 461 if you round up on the 2-year. If you push it through the FX market, you get confusion. You get dollar strength some days, you get euro strength the others. And really today, it's not moving around too much. But my eyes are really focused on European fiscal, frankly. And Anne-Marie, I'm listening to the Munich Security Conference with a closer ear this year to try to understand whether there is more emphasis by European leaders for the need for them to protect themselves and not rely on the United States.
We've seen a drumbeat of this since Davos, that they need to look in the mirror and do more to bolster the European Union, the market, and their economy, as well as their defense structure. And we heard from Ursula von der Leyen today in the Financial Times giving this interview, talking about the fact that rough times are ahead and that they want to use the same kind of subsidies that they did during COVID, that they did as one global, one European market bidding for natural gas, to build up their defense complex. And this comes as the former president is saying, if you don't hit your 2% target, we're not going to be there for Article 5 if Russia were to invade. So this is what's looming large over Munich.
And wouldn't it be nice to borrow some of that money when interest rates were at 0? Under surveillance this morning, President Biden again urging Israel Prime Minister Benjamin Netanyahu to hold off on an assault in the Gaza city of Rafah without a plan to protect civilians. Meanwhile, Egyptian authorities are reportedly preparing for a potential flood of refugees from Gaza, building an 8-square-mile walled enclosure at the border to house those fleeing the conflict. We hear stories about President Biden urging Netanyahu to do this, that, and the other. And Anne-Marie, it seems like it's falling on deaf ears.
It does at the moment as they are preparing for this ground invasion. And this is why I think you see the White House continuously point out what Biden's advice to Netanyahu has been. So this readout yesterday saying they reiterated the view that they need to not proceed with this unless there is a credible way to make sure they can shelter these Palestinians. At the same time, Egypt is not taking any chances, and they're concerned about what this might be for their border, which is why you have all these reports of this wall potentially going up.
And it's an ongoing tragedy in terms of just the humanitarian concerns, and we will be following that. Meanwhile, in economic space, Atlanta Fed President Raphael Bostic saying the Fed should not be in a rush to cut rates. Speaking at an event in New York, Bostic saying, quote, "Victory is not clearly in hand and leaves me not yet comfortable that inflation is inexorably declining to our 2% objective." That may be true for some time. Bostic adding that even if hotter than expected January CPI print is an aberration, the Fed still may need to keep rates on hold for some time. And as you've been talking about the fear of the 1990s, the reprise of some of that inflation and how that looms large over these Fed officials.
And yet we just had a conversation with Pantheon Economics, and the view there was, we don't know what this cycle is going to be. A typical Fed cutting cycle is 350, 375 basis points. However, you are dealing with a fundamentally different economy that nobody really knows how to extrapolate. Nobody really understood the impact of COVID payments and how long they would run for. And it's so, you have companies like Jupiter building up massively long positions. They think you're going to get 400 basis points of a cut in this cycle. That would be the norm, but we've just had the conversation. We are not the norm. This is not the norm. We are not seeing job cuts or unemployment or wages reaction function is a little bit more normal, but job cuts are not the norm.
Speaking of job cuts, Nike right now cutting 2% of its global workforce as it looks to counter its weaker sales outlook and growing competition. The cuts coming after the sportswear giant said in December it was looking for $2 billion in cost savings. The company saying the cuts, quote, "put us in the position to right-size our organization to get after our biggest growth opportunities." As interest in sport, health, and wellness have never been stronger. To me, the real takeaway here, Manus, is that companies feel emboldened to make these cuts. We hadn't seen this for years.
No, we haven't seen it for years. And we've actually had a couple of comments in from our viewers out there saying, why is this not showing up? And we just had that conversation with Sarah and Saxon Woods saying higher end employees are not entitled to sign on for the benefits. I'm not completely familiar with the system here, but you lose your job here and there are income levels and trigger levels which preclude you from signing on for unemployment. You just think some of the companies that have cut jobs, Cisco 5% of the workforce this week, Nike 2% of the workforce. You're also seeing Instacart along with Morgan Stanley. Oh, okay, there's small numbers at Morgan Stanley, but this is, as you say, a more emboldened management able to let people go because they can hire.
It makes me think that is there this invisible unemployment market that we don't know because it's not in the data, because these individuals cannot go and ask for these, sign up for these jobless claims. And also, it's not just the tech world. Nike, clearly apparel, last month, Levi's, 10% of their workforce. It's really broadly around the scope of job forces, but until we see it in the data, it's kind of hard to understand how much of this is impacting the real economy.
It's a great point in terms of what we're not seeing, and it's the reason why people talk about the muddle and the lack of clarity and focus on things like continuing claims. Shifting gears, Vladimir Putin's most outspoken critic has died in a Russian prison camp. Russian news agency Interfax reporting that opposition leader Alexei Navalny, quote, felt unwell after a walk, almost immediately losing consciousness. For the latest, Bloomberg's Russia economic and government editor Greg Sullivan joins us now. Greg, what's the latest and in terms of clarity that we have around the situation?
That's right. The prison service in Russia is saying that Alexei Navalny died. He died apparently after a walk, losing consciousness, but they did not give a specific reason for his death. His spokesperson on the X social media platform just recently said that one of his lawyers is in transit to the village where the prison is, but at the moment they don't have direct confirmation. Yet still, condolences and statements from world leaders are starting to roll in response to this event.
Will there be any response, Greg, on the ground in Russia?
It's hard to say. On the one hand, Navalny did build up a lot of support. He had the sympathy of people as he sought to campaign against corruption and try for public office. But on the other hand, Putin has been waging a crackdown on dissent that is some of the strictest that we've seen in decades in Russia. He's really made sure that anybody who's opposed to the regime has either been imprisoned or forced to flee. Even Navalny's organization was branded a group of extremists, and many of them had to leave the country. So whether any kind of visible outcry over this could happen remains to be seen, but certainly there will probably be some people feeling reactions to this.
Greg, we've seen some lines come through from Zelensky, who is speaking. He's saying that Putin must be held to account for Navalny's death. That's a pro forma response that you would expect. But how does the international community act in response to this? Because they're already sanctioned within an inch of their life against Russia. They're already exerting forces there. How can the international community react? Words they have, actions perhaps less potent.
That is a great question. As you said, we're starting to see reactions from world leaders, especially in Europe. Largely, by and large, they're blaming the Kremlin. They're blaming Vladimir Putin for the death of Navalny. But it's unclear what exactly they could do. They have sanctioned Russia pretty heavily, its financial sector. So what tools they have to actually exert influence remains to be seen.
Greg, when we take a step back, I'd love it if you could give us some context for Navalny's importance in a society that's been really ruled with an iron grip by Vladimir Putin. Can you give us a sense of the role that he played as the lone voice of dissent in a country that has really devolved into very much of what people understand as a dictatorship?
You know, that's right. Navalny has actually been a figure who's been in the public eye for years at this point. He started off as sort of a local campaigner, activist, opposition politician. He campaigned against corruption. His organization frequently sought to try to expose corruption. He ran for public office, though he was also barred from running for public office by the Kremlin. In a lot of ways, he was the most prominent, the most visible opposition to the Kremlin for years in Russia. So as that, he garnered some sympathy and clearly a lot of notoriety. There was the poisoning attempt on his life, which also probably helped his status. He, of course, flew to Germany for treatment, but then made the decision to come back to Russia, where he was arrested. The Kremlin crackdown on him was severe. He was sentenced to about 30 years in prison on various charges, most of which the U.S. and the EU said were politically motivated.
And most recently, a remote Arctic prison. Greg, who fills this hole in Russian society? I can't think of another name that is going to come out and be as critical of the Kremlin as he's been.
Well, it's really hard to think of how that could actually happen at this point. Some of the crackdown on dissent that has come from the Kremlin has come partly in response to Navalny, and at this point, it would be hard for anybody to emerge. The Kremlin has really taken any and all dissent quite seriously, and as we saw with Navalny and about 30 years worth of prison sentences, it would be very hard for someone to kind of fill that stature again. There very well could be critics in the future, but whether they gain the same sort of stature or the same widespread exposure seems doubtful at this point.
What do you think Putin's response will be on this? How do you think he will handle this? Do you think that he will be just very aggressive about it, or how do you think he's going to speak to the nation and to the world? Because how he prevails here can give us some indication, perhaps, what we can expect for the rest of the year in regards to the Ukraine-Russia situation.
Well, we already have heard from the Kremlin spokesperson that Putin has been informed of Navalny's death. The way Putin has handled, and the Kremlin in general has handled Navalny, they rarely name him. Usually they don't name him. They refer to him condescendingly as the blogger or very dismissively. It wouldn't surprise me if Putin didn't address it publicly or in an offhanded way. He has at times been floated unproven theories about how he's potentially been poisoned, or so I don't expect a very direct, or at least a very sincere response on the part of Putin, especially as we move forward with the presidential campaign.
Greg Sullivan, thank you so much for being with us. We are just seeing this reported by CNN. The National Security Advisor Jake Sullivan says that the U.S. is seeking confirmation of Navalny's death. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hakas. Yahira.
Hi, Lisa. Travel is picking up in China during Lunar New Year. That is offering some hope that spending might also pick up. More than 61 million train trips were made over the first 6 days of the national holiday holiday. That's up more than 60% from the same period last year. China's economy has been struggling with growth concerns amid deflationary pressures and the ongoing property crisis. Apple is racing to ramp up its artificial intelligence capabilities, with the company close to releasing a new tool for app developers. It's understood the new system will use AI to create code more quickly and compete with Microsoft's rival system, GitHub. Apple has been working on the tool for the last year as part of the next major version of its flagship programming software, Xcode. Coinbase shares are rallying in the pre-market after the company posted a profit for the first time in 2 years. Revenue jumped about 50% in the fourth quarter to more than $950 million. That topped analyst estimates. Wall Street has been watching Coinbase closely for signs retail revenue at the U.S.'s biggest crypto platform will be cannibalized by the newly launched Bitcoin ETFs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Treasury yields hovering near 2024 highs.
We're still in the camp that investors should gradually extend duration. Even if the timing of that rate cut gets pushed back a little bit, we think investors should still kind of move out a little bit and lock in those yields.
That's coming up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
About 45 minutes until that key PPI figure that adds to the muddle that we've gotten so far this week. If you're looking for clarity, good luck. Right now, we're looking at markets that found their clarity, at least in a couple of the stocks, although you have seen a little bit of a pullback in NVIDIA this morning. Just want to bring that up as part of the market check. 53 on S&P futures, up about 0.1%. Eurodollar doing nothing. 10-year yields up almost 4 basis points now, actually continuing to climb ahead of that key data, close to the highs of this year, as we were talking about earlier. 427 now rounded up on the 10-year, and crude lower by 0.8%. Under surveillance this morning, as we were mentioning, Treasury yields hovering near the highs of this year.
We're still in the camp that investors should gradually extend duration. Even if the timing of that rate cut gets pushed back a little bit, we think investors should still kind of move out a little bit and lock in those yields. Because again, we don't expect a reacceleration in inflation. We don't expect the 10-year to get back to that 5% level we saw back then.
Here's the latest. Yields ticking higher after pulling back on weaker than expected retail sales that bolstered expectations for a June Fed rate cut, even if just briefly. Kelsey Barrow of JP Morgan writing, quote, "While there will inevitably be volatility, It is important to remember that most likely path for monetary policy is that it will be easier at the end of the year than it is today. Now is still an attractive time to lock in high real yields in fixed income. Kelsey Barrow joins us now. Before we get into the calls, what did you make of this week's muddle?
So I would agree it was a muddle. You had the upside surprise on CPI, you had the downside surprise on retail sales, and I think this really exemplifies the phrase that the risks are balanced, right? You hear people saying the Fed may need to hold through the end of the year. You also hear people saying by the end of the year they may have cut 400 basis points. I think this exemplifies why fixed income is such a good diversifier in your portfolio right now. So if you get the scenario where yields, the Fed just stays on hold through the end of the year, what do? You clip your coupon. It means the economy is still strong. You're getting returns probably equal to about the yield on the aggregate. So maybe that's 5 or 6%. In the event that the economy does slow more and you do get more substantial rate cuts, you can see significant capital appreciation in your high quality fixed income portfolio.
There was one theory put out there this week that we could be heading into a 1990s type of scenario where the Fed cuts rates and then has to hike them again shortly thereafter, maybe not in the same year, but in 2025, 2026 in response to resurgent inflation. Why do you reject that as a concept that really was exemplified by hotter than expected CPI?
So I don't think we should reject it. I think that there are a variety of outcomes that could occur, and we need to be humble to the fact that we don't really know. But what we do know is what the market is currently priced to expect. The market is already priced for somewhat of a 1995 scenario. If you look at the trough in the Fed funds rate, it's for the Fed funds rate to stabilize around 3.6, 3.7%. So that's about, 100, 150 basis points of rate cuts, and then they pause. That would actually be very similar to the 1995 scenario. So the market is already telling you, yeah, maybe that's what we're going to get. And then in the event that things slow down, you have a lot more policy space than you've had in a very long time. I mean, don't forget, during the pandemic, the Fed only was able to hike to 2 3/8. So they only had 200 basis points of policy space to ease when things got bad.
So with that scenario, the market's treading this bandwidth, isn't it? 375 at 425. It's trying to break out. Transfer that over into the credit market because they can get 5.5, 5.8, nearly 6% return in credit in this current environment on a reasonably soft landing. So what is your thinking on the credit scenario, given the lack of clarity on whether we get, 100 or 200 basis points of cuts?
Yeah. So when I talk to our credit analysts, they are very unanimously still very positive on the companies that they cover. When you look at the earnings that we've seen over the last few weeks, they've been saying to us, listen, revenues are coming in better than expected, but even more interestingly, earnings are outpacing revenues. What does that mean? It means that margins are expanding. So in general, it's been a very positive time for credit fundamentals, and that's being backed up by flows. We're seeing flows into fixed income, and we know that there's $6 trillion in money market funds. That's cash that's waiting on the sidelines. If you look at how the assets in money market funds develop over a cycle, they're not forward-looking. They tend to chase the Fed once the Fed has started cutting. So we want to be encouraging those who are in cash. Don't play musical chairs. If you play musical chairs, you're going to end up being the one without the chair when the music stops. Lock in those yields now so you're not the one left without a chair.
Do you feel that you don't have healthy competition then from the equity markets? I mean, these equity markets are just sort of like roaring. I mean, 11 record highs so far this year. I know that you're in the fixed income house, so you've got to put your cap down and go transfer into fixed income, which is a fair bet. But when it comes to that flow show, do you really think out of those money markets it's going to be much more into high grade credit and into sovereign?
I mean, I think it's probably going to be across the spectrum. And so we're not saying that everything needs to be in
everything for us.
Yes, we're not that greedy. But we do think that there is a place, and that place has been underestimated and underallocated, and for good reason. Okay. If you look back 10 years ago, I mean, we were talking about a situation where the Fed was at the zero lower bound. You had multiple central banks at zero. There were 10, 20, 30% of the global ag had negative yields, right? It was a totally different environment, and that's why people were under-allocated to fixed income. Structurally, we think we're in a different time now.
Can you give us a playbook of what you do with the data as it comes in, given that there are people who try to trade it, and then there are other people who say it's more than musical chairs, you're just asking to get burned?
Oh, Lisa, I love that you asked this question because I know both of us are very excited and interested to see the PPI data. Dynamically, there are opportunities to be tactically adjusting duration in your portfolio. This year, we've seen a number of opportunities to do that. We've taken advantage of them, and there will likely continue to be opportunities to do that. You want to ultimately, though, look through the noise, but the reason why PPI is important for the benefit of the viewers, it's not actually that headline number on PPI, it's the subcomponents of PPI that directly feed into PCE, which is the Fed's preferred measure. Some of those components, medical care insurance, auto insurance, airfares, those are categories that directly feed into PPI, or into PCE from PPI. And it is a confusing story. I don't think that we should ignore the fact that the wedge between CPI and PCE right now on core is over 100 basis points, and on super core, so core services ex shelter, it's 200 basis points wide, right? There are just differences in the way that inflation is measured, right? There's different ways to do it. The Fed has told us they prefer the PCE measure, and that's why we're so focused on it.
And there are these distortions and things like auto insurance, which have gone through the roof. Just talking on the tactical trading, is 430 and around there for a 10-year about the peak that you see for this year? Is that a solid buy sign?
So for now, I would say that does seem to be a technical level. I think the 100-day moving average is around 433, 434, and so far that's held. A few days ago after the strong CPI print, we tested that overnight. I remember waking up, seeing that we had hit that level, and then we had bounced off that level. So I think for now, that seems reasonable. We still have to see what the data is going to hold. You know, the Fed is beholden to the inflation data. Right now, they have a year-end forecast of 75 basis points of rate cuts that's consistent with core PCE at 2.4%. Even if we get a stronger than expected PCE report at the end of the month, let's just say a 0.3 month over month, the 3 and 6 month run rates are still going to show the Fed is on track. So I just want to make sure that people know not to overestimate one data point. We do still need to be sensitive to the trend.
Kelsey Barrow, thank you so much for being with us. Kelsey Barrow of JP Morgan Asset Management, who is not playing musical chairs. And probably I should not either, because I always was left holding the bag. I don't know. It was, you have to really be aggressive and push people out of the way if you want to get that. You know what I'm talking about, Emery.
I always had a chair.
There's no shock in that, is there?
We'll talk about that coming up. No, we won't. Kristen Bitterly joining us of Citi, as well as Steve Rasciuto of Mizuho, James Lucier of Capital Alpha Partners, and Jennifer Bartashes of Bloomberg Intelligence ahead of Walmart earnings next week. Of course, we also do get NVIDIA earnings. The read on the U.S. economy ahead of PPI with just almost 34 minutes to go. This is Bloomberg.
China has played an important role in trying to send a message to Putin not to stretch, particularly when it comes to tactical nuclear weapons. But I think China's also been surprised at how difficult it has been for the Russian military to achieve their military objectives. I think that's caused China to do some serious evaluation internally about their own military. I think that's part of what we may be seeing with some of the changes in military leadership, with the assessment that, everybody thought the Russian military was very effective. It turned out not to be. What are the lessons we can learn? I think the more important, decision right now is for the United States, Europe, and other like-minded countries to continue supporting Ukraine, support them with the military equipment they need in order to, hold the line and push back as much as they can. The more equipment that we can provide Ukraine, the more they can defend themselves and try to take back the territory that has been seized since 2022. That should be our objective. That's what we should be focused on.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg.
The longer that financial conditions stay tight and rates are restrictive, you will see that impact activity and see things slow down.
We are expecting a slightly slower economy. We think that that will open the door to rate cuts.
You'll probably get some capital appreciation if the economy slows, as we think it does, towards the end of the year.
We think the trend is still towards disinflation. The Fed will probably be cutting in May or June.
It feels like the uncertainty this year seems to be higher than it was last year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
29 minutes until the latest read on inflation. Welcome back. This is Bloomberg Surveillance for our audience worldwide from New York City. Anne-Marie Hordern, Manus Cranny, Lisa Abramowitz, Jonathan Farrow is off today. Right now, we are waiting for the PPI data to drop, the latest in terms of factory prices. And then when it does, Manus, we can look at that and say, why does this not look like everything else? And how do we put it into some sort of picture that looks very cloudy right now?
Well, we just don't care, do we? I mean, we just shredded, the bond market just shredded itself on Wednesday on the hot CPI. Then it got reminded by Goolsbee that, it doesn't need to, inflation does not need to be hit 2% for us to start to cut rates. And then retail sales, it's been whiplash of a week in reaction function by markets to data.
Which is the reason why we bring in our expert on musical chairs, Anne-Marie Hordern, to talk about what this means for going forward. Honestly, this is sort of how much can you ignore? And we've seen this with respect to geopolitics, that there just has been so much noise that markets have ignored. Ultimately, a lot of people talk about just how much money has been put into the system, how we have seen people that are largely fully employed. How much is this sort of the gift that allows Washington to continue with its dysfunctionality?
Well, I mean, the White House and the Democratic Party will continue to remind you that the unemployment rate has been below 4% for 2 years. But you have to start to think about, we heard from Sarah in the last hour, those individuals that get laid off but are at the higher end of the bracket and actually don't show up in the data. So is there some like invisible unemployment? But yeah, Congress will continue to just talk about the fact, or at least the Democratic Party, they will talk about the fact that we are better than where we were pre-pandemic, or the depths of the pandemic.
Which is something that people keep looking at as a reason to be bullish on equities, on risk. And Manus, from your perspective, you were looking at all of the flows and noting just how massive they've been. Is it all driven by the AI craze, or are people starting to try to get further into other asset classes? That's been one of the big questions underpinning some of the flows.
I think everybody hopes to sort of reach for breadth, but it just hasn't happened. The concentration risk, according to Bank of America, this is one of the most concentrated markets. The U.S. market equity breadth is the worst since 2009. Yes, there's still this sort of wave of money coming in. Stocks posted the best, 4-week inflow since 2022. So you're still seeing a real wave of money coming in. So there's no lack of velocity in terms of new money, to steal a phrase from somebody else who usually sits in this, or who has sat here. But it's a question of, what do you need to validate? What validates that flow?
Which is a reason why people are looking at this rally and sort of tepidly kicking in. What we're seeing right now is a continuation of that kind of trend. You see equities up about 0.2%. They've been hovering here this morning. Not a lot of drama, but still solidly across that 5,000 mark on the S&P 500. Euro dollar doing nothing. Let's leave that there. 10-year yields up 4 basis points and continuing to climb throughout the morning before this key inflation data that people are going to be parsing through to understand how this bleeds into the Fed's key PCE metric. Yields near the highest of the year, and crude lower. And this has really been a story that people are wondering, when is it going to break out? Anne-Marie, you've been asking time and time again, when are people going to start focusing on the fact that there is this geopolitical risk? Is that baked in at all?
They're ignoring it. And Rita Sen says it's because the risk isn't there to the actual supplies. No supply has been hit. But none of this will change until the demand really comes back in China.
Which is the reason why people are continuing to parse through that economy and maybe see some green shoots if you like to buy things that other people say are uninvestable. Coming up, Citigroup's Kristen Bitterly on markets as the S&P 500 hits a new record high. Mizzou host Steve Rasciuto reacts to PPI. And Jennifer Bertashis of Bloomberg Intelligence previewing big box earnings that come out next week. We begin with our top story. You love it. It's bad news, good news. Stocks at record highs on the back of weak retail sales. The data offering some relief, while investors look ahead to PPI coming in less than 30 minutes. Citi's Kristen Bitterly saying this: softer economic data this week contrasts with stronger than anticipated CPI. A sustained rise in continuing jobless claims and relatively weak retail sales all point to the economy softening a bit. Kristen joining us now. Kristen, how do you look at this? If it is softening, is that time to buy equities or is that time to sell? How does that factor into your call?
I think what's really interesting is that the reaction function that you were talking about, the market is reacting so quickly on a daily basis to the data and saying, okay, does this fundamentally change anything with our thesis? And I think you have to take a step back and say, what do we know to be true going into this year? And there's a couple of key points. One, the cash on the sidelines, extreme. The $6 trillion mentioned earlier in money market funds. When you actually look at the totality of cash balances, that's actually a lot higher. So you have cash on the sidelines, you have Fed funds that have peaked, right? So this idea that, is the first cut pushed out? Yes, it is. But does that really matter for equity investors? Inflation has also peaked. There could be volatility in terms of the data, but you can see a trajectory down to about 2.5% by the end of this year, and earnings have also troughed. So you add up those 4 things, and it's actually pretty constructive for profitability and risk assets.
How much has the economy and markets, how much have they gotten divorced from one another at a time where companies are preserving their margins by making cuts? And that's going to be necessarily negative for certain swaths of the economy, but that means that they can keep delivering earnings.
Yeah, so I don't think the economy and markets have completely disconnected. I think markets were ahead of the economy in a lot of ways in terms of the recession that everyone was expecting was an earnings recession. And we saw it last year. We saw it actually starting in Q4 of 2022, where you had 7 out of 11 sectors already in a profits recession. I think to end 2023, it's the highest percentage of stocks in the S&P 500 outside of recessionary conditions that were in earnings decline. So you had the earnings recession that already happened. Truth be told, the economic data is still pretty strong. It's softening, but it's not weak. And so I think the key thing and why everyone's focused on PPI is how it feeds into PCE, which is the Fed's preferred measure. And then that's what the Fed really needs in terms of their trajectory and really making that first rate cut.
I see here that you're a buyer of dips. So tell the truth. This is a truth and reconciliation moment. You come to surveillance, which is you're secretly hoping that NVIDIA has a bit of an underplay next week. So it provides this beautiful opportunity for you to step in and pick up where you perhaps are lighter than you'd like to be.
So what I would say is this is the #1 question that we're getting from our investors. I'm not picking on NVIDIA specifically, but really this dislocation between Magnificent Seven and the rest of the market. So going back to what I just said, you look at the other 493 names, it's a very different earnings story. It's a very different story year to date in terms of their performance. I think within portfolios, you look at these companies and if they continue to deliver earnings growth in excess of 25%, the market is still going to react quite well. And you look at just the size that they represent in the overall index, it's 20% of earnings contribution, but 28% of market cap. So if investors are just pouring into passive instruments and index trackers, they're going to benefit from that bid as well. So I think there's more value in the broadening out story, but you have to be involved in these large companies as well.
And when it comes to those large companies, I mean, this is the other thing from Bank of America and their flow show, where they talk about concentration risk being the worst. Also, the breadth of this market is the worst since 2009. When you look at the 493 other stocks, where do you want to be? Where is the opportunity?
Yeah, so I think there's a couple of key areas. And again, this is based on that thesis that we have seen peak Fed fund rate, that we have seen peak inflation. There could be some volatility, but once we actually get that first rate cut, you're actually going to see the market react so fast to that, so you want to be involved earlier on. So a simple expression of it is just simply doing the equal weight S&P 500 versus the market capitalization weight to play that broadening out. But I think from like a sector perspective, you can even look at areas like healthcare and investing in biotech, longevity.
Do you look for the AI influence sitting over the...
Of course.
I mean, if you're not hearing a robust AI narrative, let's say from Novartis, I just saw the Novartis CEO is going to be on TV a little bit later on tonight. But if you're not hearing a robust AI narrative that's deliverable across the 493, does that help you discern where you want to be?
I think you have an AI narrative, but you also just have a profitability narrative. So the flows are going to go into, or go away from, I should say, any company that doesn't have their balance sheet in order, any company that is not having sustainable profitability, because of course, even if we get those rate cuts, we're still in a higher interest rate regime and it's harder to be profitable. So you want that quality and profitable filter. But AI, I think you hit on something really important with this. A lot of the flows into Gen AI have been in the pure kind of producers of the technology. There is a whole part of the market that are the beneficiaries from a productivity standpoint, and that's areas like cybersecurity, which is one of our favorites. It's also areas like healthcare, biotech, longevity, in terms of using that type of technology to bring drugs to the market in a faster fashion. So we're going to be hearing a lot more about those tangible productivity gains this year.
Has the underperformance of the Russell 2000 become a viable dip?
So Russell 2000, I have to say, when I look at the broadening out story when it comes to small caps and mid caps, the Russell 2000 is all encompassing, right? And it just has like such a market reaction function to interest rates, to the broader growth story as well. When you look at some of the indices like the S&P 400 and 600 when it comes to small and mid cap, where you're getting that quality kind of filter, you're getting a profitability filter, there's ways to play in that space and get exposure to the sectors that could benefit. But again, with stronger balance sheets than just kind of the whole small cap space.
Citi's Kristen Bitterly is going to stick with us. Coming up, we are going to be talking more about the broader fiscal landscape as we take a look at that cash on the sidelines. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. Jeff Bezos is selling more Amazon stock. The founder of the company offloaded another 12 million shares valued at $2 billion. It brings the total he sold in the past week to more than $6 billion. Bezos hasn't explained why he's planning to sell as many as 50 million shares, but the timing is likely linked to his move to Florida, which has no capital gains tax. The Justice Department plans to scrutinize Disney, Fox, and Warner Brothers Discovery over their proposed sports streaming service. Regulators are concerned the new joint venture could harm consumers, media rivals, and sports leagues. Earlier this month, Disney, Fox, and Warner announced they would team up on sports content, putting it all in one app. Sources say the DOJ will review the terms deal once it's finalized. Vornado Realty is considering several concepts as temporary replacements for a skyscraper near Madison Square Garden. Proposals include U.S. Open tennis courts, a tent set up for events like New York Fashion Week, and basketball courts. The space was cleared when Hotel Pennsylvania was demolished during the pandemic. A company spokesperson says the renderings are for, quote, conceptual purposes, and several interim options are being considered. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I have to say, Kristen, the death of The Office, overplayed?
Look, I think, what are some of the trends that we're seeing more broadly? What I would say, no, but what I would say is when you look at some of the earnings that we've seen this past quarter and some of these companies and their ability to pivot in terms of, for example, malls, like there was the death of the mall, and malls are no longer about going there to buy products, but the experience that you're gaining. And so I think there's some very creative strategies that companies have employed to help mitigate some of this.
Diplomatic answer. Up next, Congress bracing for another shutdown deadline.
It's been such a chaotic last few months for this House. Do they want to be humiliated further? Mike Johnson has lost his halo. I think he does not need that kind of publicity.
That's coming up next. You're watching Bloomberg.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and
beyond. What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
To go. We are excited to parse through PPI right now. Welcome back. This is Bloomberg Surveillance, taking a look at markets climbing back up toward new highs, firmly across 5,000, up 0.2%. You can see across the board a really quiet day, except for in the yield space. And I want to sit on this for a minute because we are seeing session highs on the 10-year, on the 2-year, as people wait for that key inflation metric that feeds into the Fed's favored look at inflation, PCE. 428 now if you round up, 427.52 if you don't. Right now, under surveillance this morning, Congress bracing for another shutdown deadline.
It's been such a chaotic last few months for this House. Do they want to be humiliated further? Mike Johnson has lost his halo. I think he does not need that kind of publicity. I do think that some kind of continuing resolution for the entire rest of the year is on the table.
Here's the latest. House Republicans saying they won't pass a temporary stopgap funding bill to avoid a partial government shutdown. The deadline just 2 weeks away on March 1st, right after the House returns from recess on February 28th. Joining us now is James Lucier, senior political analyst at Capital Alpha Partners. We were talking earlier with Greg Valliere, who answered Anne-Marie's question about what the likelihood of getting it done was. Didn't seem too optimistic. What about you?
Well, I think D.C. has actually been pretty optimistic on the substance for a while. The House and Senate are actually pretty close on top-line numbers and the so-called 403B allocations. In fact, we've been pretty nonchalant about shutdown prospects. The issue here is process. How do you get a bill onto the House floor, which a bipartisan majority would surely pass at this point, and the appropriations writers for which the House Freedom Caucus guys are rolling out? What's making us nervous is just the train wreck that we've seen in the House of Representatives, especially with disaster after disaster after disaster, demonstrating that Mike Johnson can't run the floor in these past 2 weeks. So substance looks good, but the process is going to be a nightmare.
And then they only have 3 days to do it when they come back from recess. So that increase your risk of a government shutdown?
Well, it does, but remember that first deadline is only for the first big four appropriations bills, including, I should note, the defense bill. There is a reasonable prospect that Ukraine, Israel, Taiwan funding gets loaded onto that. But 1 week shutdown is something that we don't see as a big deal in Washington. It's good enough for government work. So I think most people have been expecting some kind of a bumpy end to this process. I would agree that a long-term CR is something that's certainly on the table. But again, the issue really isn't the substance of what they're doing. It's essentially the mechanics, how you can get this done on time, given chaos in the House and the need to conduct an impeachment trial in the Senate.
There's been news this morning that Alexei Navalny, the opposition leader in Russia, has died. And MSNBC is saying Secretary of State Antony Blinken says, quote, Russia is responsible for this. Would this incident now give fresh impetus on Congress to actually act and move on the foreign aid bill?
Well, I'll tell you about another incident, which is the announcement by a Republican committee chair just the other day that the Russians have a new space weapon about which members of Congress are being briefed. That's a signal. It's clearly Putin rattling their cages, but it shows you the level of concern about foreign policy. I wouldn't say that Navalny is the one thing, but he is the latest important thing in a series of big developments. The Biden administration has to worry at this point because strategic failure in the Middle East has been the graveyard of one presidency after another. They need to get through the Middle East, and they need to do it at a point where Russia is exploiting the crisis in the Middle East to make its own gains in Ukraine.
Cool. Let's talk about the Middle East, because we did have the president last night on the phone with Netanyahu. They're trying to push for a way that they want to make sure that if Netanyahu is going to go into Rafah, that civilians are protected. Where do you see the president in terms of the electorate of his handling of the situation in Gaza? Are they still continuing to give him poor remarks?
The president is very much a Vietnam generation senator. He was elected in '72. He was never anti-war, but he has been dovish on every major foreign policy issue in the past 50 years. And he's looking at truly horrifying election numbers right now, where he is upside down. He is net negative 55 points among younger people, 18 to 34, on his handling of the war. And really, among Democrats in general, he's down. He's net negative by about 40 points. So Biden needs to put the brakes on Netanyahu, show some decisive action, and achieve not only his humanitarian goals in Israel, but also hold together the Democratic Party, which is being torn apart at this point on geographic, ethnic, and generational lines. And also, of course, on whether people watch Bloomberg News or get their news from TikTok.
They do, and that's maybe where they'll put a little bit more of the president rather than in open forum. James, it would appear, and I use the word loosely, it would appear that Netanyahu is not listening to any global leader, and he's made it very, very clear last night that he's not going to have anybody dictate to him. 28,000 people, we understand, have lost their lives already. Does Biden really have influence? He may have access but it certainly doesn't look as if he has any influence.
Well, Biden has access and Biden has influence. Netanyahu is not listening to global leaders. He's listening to the major political parties in Israel. And just as President Biden is increasingly boxed in by his domestic constituencies here, Netanyahu is facing the same problem in his country. So it's not like he's not listening. He's got to make a choice. Does he listen to Biden, or does he listen to his allies in the Knesset who want him to take a harder line?
James Lucier of Capital Alpha Partners, thank you so much for being with us. Still with us right now is Citi's Kristen Bitterly, and we talk a lot about how people don't want to price in the election per se. There is, though, policy differentials that are coming to the play that are factoring very much into investments. How are you looking at some of the trade policy, some of the tariffs, in terms of where you want to allocate and where you're a little concerned?
This is one of the major themes, I think, in the difference between 2024 and 2023. Last year was all about, I was joking earlier, everyone being a part-time economist and parsing through inflation data and what is the Fed going to do and the trajectory of rates. And this year, and we've been traveling around the globe with our outlook for 2024, the number one concern is geopolitics and actually elections. And so when you look at the data and say, even for the US market, how do US equities perform in an election year? It's actually quite positive. So, and especially when you have an incumbent running, you tend to have volatile months leading up to it. But obviously we could make the argument that this year is different. So one of the areas in the way in which we're exploring this within portfolios is through a theme just called economic security more broadly, looking at these themes and saying everything from nearshoring. Economic security has to do with access to chips. And so investing in the equipment makers and chip makers, even something like I mentioned earlier, cybersecurity and the increased demand and need for that. So there are tangible secular trends that I think make sense from an investment standpoint, but we're certainly not trading portfolios around elections.
You mentioned markets will stay positive, and part of that is because it's an incumbent. But this election is different because there's two incumbents. So you could almost set up your portfolio for what you saw from 4 years of Trump and from what you saw from 4 years of Biden.
Yeah, so I think like when it comes to, when you look at how our portfolios are allocated right now, they're actually very balanced across fixed income and equity. And so we've been taking advantage of the yields within fixed income to build, because even with the volatility that we've seen in rates, you still have a lot of these areas of the fixed income market that are at 15-year highs, and you're buying that for the yield. Yes, there's an argument for some total return, but you're really buying that for the yield, and you're buying individual bond positions. And if there were some type of volatility or shock, that then would really provide that benefit in your portfolio from a reaction function.
Kristen Bitterly, thank you so much for being with us.
Thank
as
you.
always. Kristen Bitterly of Citigroup Global Wealth Management. Coming up next, we do get that PPI data. We're about 5 minutes away. Breaking it down for us is Mizuho host Steve Risciuto. Right now, we're looking at markets that are kind of treading water, but Manus, honestly, to me, I'm curious about whether this will edify the CPI that we got or whether this really speaks to the weakness in retail sales.
I think it's going to be, whatever way it goes, it's going to be another argument as to why we need to focus on the PCE, and that will be the narrative from the Fed, and that is the be-all and end-all that we need to focus on. We've been told that this week several times.
It also highlights just how much this revolving type of economic cycle has been unusual. Right now, we're watching markets continue to grind just a touch higher. This is Bloomberg.
very, very short period of time.
Yeah.
Every single child, every single student, everywhere on this planet will actually have access to a tutor, someone who can help educate them one-to-one.
In their pockets.
Right, and we know that one-to-one education is, in fact, the one that has the best value and the best outcome. So the idea that you can have custom to who you are, to your language, you know, male, female, young, old, relatable, you know, funny, serious, Shakespeare, whoever you want, can be your tutor, your teacher that you can learn from. Just seems to me like such a amazing transformation across the globe.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Just seconds away from the latest in a slew of inflation data, PPI, that nobody cares about until they do. But I am particularly interested in this year, this month, considering the fact that we got that hotter than expected CPI. Markets are quiet ahead of this. The expectation is for just a slight uptick, but nothing like what we saw for CPI, up 0.1% on the headline figure. With those numbers, let's head down to Washington, D.C. Michael McKee is there, hot off the plane from Salt Lake City, Bloomberg economics and policy correspondent. Mike, what are you looking at?
Well, right now we're looking at a hotter than expected PPI going along with the CPI. Producer price indexes for final demand rose 0.3 on the month after a negative 0.2 drop in December. In the energy, the ex-food and energy rises 0.5%. After a down 1%. Ex-food, energy, and trade up 0.6. So we see some very strong strength in the final demand numbers on a headline basis. On a core basis, even worse. Final demand, final demand for core was up 0.5%. On a year-over-year basis, final demand up 0.9. That is a drop of 0.1. Base effects in effect there. The core 2%, and ex-food, energy, and trade 2.6%. That one rose some. Housing starts are also out, down 14.8% in the month of January. Of course, bad weather probably contributing to that. Housing starts at a 1,331,000 annual rate. Building permits down 1.5%. So it definitely looks like builders pulled back, and that may be weather related. We'll take a look at what is driving the PPI while you take a look at how the market is reacting.
And the market is reacting, Mike. Thank you so much to it. This is exactly as you would expect. Yields higher, stocks lower, particularly the Russell 2000. If you take a look, Russell 2000 underperforming significantly, once again down 1.2% on the heels of hotter than expected numbers. I should note there were downward revisions to the month before. Still, the average speaks to this inflationary impulse. S&P futures lower by 0.1. NASDAQ holding on to some gains. If you take a look at 2 10s and 30s, which you can see is two-year yields kissing the highest levels of 2024, once again up sharply, almost 10 basis points, 4.67 right now, 4.67%. 10-year yields up 8 basis points, almost 3.1%, and 30-year yields up about just a half of just 5 basis points, which we're looking at in currencies. As you would expect, there was a bit of a reversal of some of the previous euro strength, euro weakness now versus the dollar, 107.49. Mike, just quickly here, I'm curious about whether the revisions change the picture at all, or whether this is a solidly inflationary picture, especially with the components that feed into PCE.
Well, you're putting your finger on one of the problems here. It looks like an an increase, the kind of increase that we should worry about a bit. 2.2% increase in the hospital outpatient care area, which does feed into PCE. Now, one of the issues is in January, you tend to get these kinds of increases. The seasonal adjustment factors are supposed to take that into consideration. So not clear exactly how this is going to end up affecting PCE, but it should push it a little bit higher. The other thing that people have been watching for is securities brokerage and dealers. They had been making more money raising prices as the market continued to go up. That was up 0.7 during the month, which is down from a 2% rise the month before. So not as much of an impact, but it did have an impact on this overall. Index for goods down 0.2% in January, whereas the index for services was up 0.6, and that's the most since last July.
Mike, do you think this is going to be more troublesome for the Fed and for the market to digest? It was easier to move through and look through the CPI on Wednesday because it didn't have a material impact, as it were, on PCE. But here we are. We will have bleed through from this higher 0.3%. The estimate was for 0.1%. That's a significant miss in terms of the estimate. Is this one going to be harder to push away for the bond market?
Depends on how the bond market is thinking about it, and if they're worried about what the Fed is going to do. Of course, we've been cautioning people not to pay a whole lot of attention right now because they're not going to move in March, and so we have a lot of data to come, but it may show a little bit of a rebound in prices. January can be difficult because of the seasonal adjustment factors, so we'll have to see what February turns out to be, but obviously after a long string of declines in the producer price index, this is not particularly good news.
Mike, thank you so much for this. Michael McKee will be catching up with you throughout the day. If you are just joining, we just want to recap where we are. Hotter than expected PPI, in particular, some of the components that feed into PCE. Final demand headline number, month over month, 0.3% versus the expectation of 0.1%. If you look at a year over year basis, it's up 0.9% versus the expectation of 0.6%. Bleed that through the markets, and it's pretty much as you would expect, 1.4% decline, underperformance on the Russell 2000. Yields on the 2-year reaching 2024 highs, now almost to 470, 4.69%. If you round it up, it's 470. And across the board, really, but on the front end is where you're seeing it the most, and you are seeing a bit of dollar strength. Steve Rasciuto, chief economist at Mizuho Securities, sitting alongside us. Steve, what's your reaction to these figures?
Well, I think the market is going to need to do what it should have been doing all along and take a look at the SEP and say how much is reasonable to think about the Federal Reserve cutting interest rates. You know, we began the year with the market anticipating 5. We pushed a little bit beyond that. The market's going to have to come into being bounded from below by 3. And then the question becomes, is it 3 or is it less than 3? Not whether it's going to be more than 3. Clearly, this data, clearly the data we're seeing on the employment numbers, clearly the data we're seeing on claims, the confluence of data are all telling you this economy has more resilience. And I would say number that doesn't get much reporting on but should have was the import price numbers the other day, which really showed the non-petroleum import prices having a bit of a kick up, and that's really a negative for the goods component because you saw, as Mike mentioned, the goods component's on the weaker side. It's the service component that's driving this.
And yeah, and I'm looking right now at ex-food and energy, just stripping out some of the commodity play, and you could see that increased from the previous month, and now year over year is 2% versus the expectation of 1.6%. From your perspective, how important is this from just a Fed rate cutting cycle point of view versus a real threat of a resurgence of inflation that we haven't yet seen?
Well, I mean, the speed at which inflation came down was incredible, almost unbelievable. So to see some backup to a more realistic deceleration pace is not something that we would be surprised to see. However, I think you have to keep in mind from the underlying perspective, a tight labor market leads to wages. Wages lead to service-producing inflation. And that really is the problem for the Federal Reserve. The goods component, there's a global deflationary force that's out there. It's real, it's palpable. It's being reflected in terms of the people's investments that want to come into the United States for investable funds. All that's happening is holding the currency. But the real domestic story is a service story. And that's the battle, the global deflation versus the domestic cyclical inflation. And, you know, the global deflation had been winning. It's now time that the domestic and cyclical inflation story win for a while.
Steve, good morning. So where we are right now is a market desperate to see inflation cascade back, the disinflation story get back towards 2%, because that's the perfect theory. But the reality is the Fed are talking about a higher for longer period. Do we need to really get used to in markets higher rates of inflation and higher rates on we're moving into a new era for rates and inflation, all just slightly hotter than it was in the past 10 years?
That's an interesting two-pronged question. The first part of it goes to real returns, and the second part of it goes to inflation expectations. You know, there's clearly a sentiment that was being voiced at the end of last year and the beginning of this year by a number of the more dovish members of the FOMC that, you know, 2% is our objective, but it's not really our target. You know, we'll deal with where the target should be in 2025, and, you know, maybe if it's 3%, that's fine. So, you know, that's one half of the equation, which the bond market hasn't really been pricing. The bond market has been sitting here saying, you know, we're pricing the 2% inflation risk premium. The front end of the curve is sitting there saying this economy is not responding, and Raphael Bostic was very clear about this yesterday, and they're scratching their heads in a number of places in the Fed saying the economy is not responding to interest rates. What's different now than was there before in terms of the response mechanism of the economy to short-term interest rates? And the answer, I think, is pretty clear. We're less sensitive to short-term interest rates now because nobody's funding short. That's the key thing. Corporate America doesn't issue short-term debt. Household America is long duration in their debt obligations, and most of their debt servicing costs are locked. So when I hear people say, oh, yeah, but look at what corporations are paying for new debt, I'm like, yeah, but when you look at their net interest expense of what they're buying, it's trivial.
So if the funding side of our personal balance sheets around this table have changed, and if corporate America's balance sheet structures have changed, talk to us about the employment market, because we've debated this for the past 3 hours, which is perhaps lower socioeconomic groups having a tough time and losing less jobs at the moment than the upper end, which are not able to file for unemployment. What do you make of that thesis? Cisco, 5% of the jobs gone, Nike, 2% of the jobs gone, Deutsche Bank switching out 3,000 jobs because of AI. So does that have any credence, or is that just, are we in the infancy of that narrative in a changing job market?
Well, I think we are in a changing job market. There's a lot of job availability. You see it from the JOLTS data in terms of the openings numbers, right? Yep. So the Fed likes the JOLTS numbers. Let's just take that for example. The openings numbers are high. So I think a lot of these people get jobs very quickly. And this is why when you look at the initial unemployment claims data, and then you look at the continuing claims data, there has been no real difference in them. They haven't been rising, which you would normally expect. But given how tight the labor market is in general, you see companies rebalancing their workforce, but you see somebody else quickly willing to come in and take them. And therefore, you're not getting the kind of response that you want because there are all these job openings. And that goes back to the fact that there is a real worker shortage in this country that people, I think, keep on forgetting. We are still well below the pre-COVID trend on employment.
So if we have a tight labor market with rising wages, no low socioeconomic unemployment, should the Fed be cutting rates?
The answer is it's a hard equation to say they should be cutting rates. I think this Fed wants
but not politically palatable.
Well, but we're not going to get into that. But yes, you've hit the point. You've hit the nail on the head. The reality of the situation is, look, if we want to excuse politics from and say they just want to maximize social welfare. Yeah. Okay, which is a fair statement. So if they want to maximize social welfare, you want to keep a tight labor market. And the inflation numbers coming down, we're giving them that ability. If the inflation numbers start going against them, I think given the asymmetric approach of monetary policy today, which says we have to respond to downside deviations in employment, but we don't have to respond to upside deviations in inflation if we're still convinced we're going to get to our target. And if the markets are still convinced we're going to get to our target, and the markets even after today are not pricing in a heck of a lot of inflation risk premium. So the reality of the situation is they just continue to do nothing and promise they're going to cut rates.
When you look at inflation, CPI, obviously now PPI running hotter, but you talked about this exceptional period where we were 9% to 3%. Why is the American people feeling it?
Well, the reality is so many of Americans had seen their real disposable income get crushed as a result of the upward adjustment. And what we're saying is inflation has slowed, but the actual price hasn't gone down. So the reality is when the average American goes to the grocery store, okay, they're still looking at the price of goods that are elevated from what they remember pre-COVID, and that's where their budget is assessed at. And inflation, wages haven't kept up with inflation. That's why the disposable income is back below trend. And that's the reason why the Fed wants to keep the labor market hot, because they really want to try to correct that to create the social welfare. So they're really trying to get this balancing act right. Again, the probabilities of them succeeding are not as high as people think, or they think, but I could understand why they're running the experiment. You know, it's understandable.
Steve Asciuto, thank you so much for being with us. Really fascinating to get your breakdown after that PPI data. Steve Asciuto of Mizuho Securities. Just to recap, we did get hotter than expected PPI data, in particular having to do with specific key aspects that feed into the PCE. Two-year yields now at the highest levels of this year. You can see a pretty sizable move throughout the yield curve, and actually 10-year yields now the highest, kissing the highest going back to November of last year. We'll go through that and coming up in more detail. Right now, let's get you an update on stories elsewhere. Here with your Bloomberg brief, Yahaira Hakez. Yahaira.
Hi, Lisa. Russian opposition leader Alexei Navalny has died in a prison camp. Interfax reports the Russian prison service is saying Navalny, quote, felt unwell after a walk, almost immediately losing consciousness. Navalny was one of Vladimir Putin's most vocal critics and was serving a lengthy prison service for charges including extremism. OpenAI CEO Sam Altman is working to secure U.S. government approval for a multi-billion-dollar venture to boost global AI chip production. Altman has been meeting with potential investors and partners in the United States, Middle East, and Asia, but says he can't move forward without a green light from Washington. The ambitious push to raise funds risks triggering a national security review of the foreign investment. Apple is racing to ramp up its artificial intelligence capabilities, with the company close to finishing work on a new tool for app developers. It's understood the new system will use AI to create code more quickly. The move places Apple in direct competition with Microsoft's rival system, GitHub Copilot. Apple has been working on the tool for the last year as part of the next major version of its flagship programming software, Xcode. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, big box earnings in focus. Consumers, meanwhile, are taking a breather.
Now we're at a point where the cat's out of the bag, inflation has come down, so there's no more justification to raise prices. The issue for consumers is that companies haven't really dropped prices.
We're also going to be talking about the latest response to hotter than expected PPI data. That's all up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Surveillance. We are looking at a market very much on the move following bigger than expected PPI print. We are looking right now at two-year yields that are at the highs of the year. You can see that also in 10-year yields, and what that is and what that means for stocks is lower on the day. S&P futures now down 0.3%, still crossing that 5,000 line. What you can see in that 10-year yield is 432 rounded up, and what you can see in the two-year yield is 470 and climbing. Right now, under surveillance this morning, big box earnings in focus as consumers take a breather.
Now we're at a point where the cat's out of the bag, inflation has come down. So there's no more justification to raise prices. The issue for consumers is that companies haven't really dropped prices. So we're still at an elevated level. We just stopped raising them so much. But if wages continue to rise, that will eat into margins. It does pressure companies. So then they have to go back and say, if I want to preserve my margin, I'm going to have to cut costs somewhere.
Here's the latest. Walmart and Home Depot kicking off big box earnings next week as January retail sales show a post-holiday slump. Jennifer Bertashes of Bloomberg Intelligence joining us now. And before we get to what you expect for next week, I am curious about your response in terms of pricing power, considering that we've had two hotter than expected inflation reads so far this week. Are you seeing this in terms of companies expressing that they can jack up prices and people will keep buying?
No, it's definitely a topic of the day. And when it comes to, for example, the packaged food companies, I think everyone acknowledges that the pricing power that they have is waning. They've raised prices a lot in the last couple of years, and it was justifiable because their own costs were higher. But as inflation is receding, especially in certain food categories and with certain input costs, there is an expectation that they won't take as much price increase. That said, I don't know if it's realistic for people to assume that food prices will go back to pre-pandemic levels. The world is a little bit different, and it was 4 years ago. So there needs to be a little bit of middle room there.
There is this question, though, about whether you're seeing pushback or not. It's kind of conflicting when we look at the data. Yeah, retail sales were weaker than expected, but the fact that we got two hotter than expected inflation prints, the fact that Coca-Cola said that they could increase their prices by 9%, the fact that you're seeing this pretty consistently speaks to a different narrative.
Well, you know, when these companies say that they can increase prices, they can, but that's at the expense of volume. So, you know, you can raise your prices all you want, but the question is, will consumers actually buy it? And that's where, you know, we think that we're going to see an uptick in promotional activity this year, just because they're going to need to incite consumers into purchasing greater volumes. So there's going to be a shift in the balance. The last few years, it was all about growing the top line. Inflation helped support that. Now we're looking at a very different kind of story for these companies.
Yeah, I mean, we face the supply chain challenges. What they've got now, of course, is higher wage bills on the reporting side. I'm curious to get your view on this. We'll come back to the price rises at the moment. Who's got the capacity actually to hold? It's the higher end of the market where that seems to be resilient. But talk me through wages. And if all the supply disruptions are really all gone, I'm talking to sort of big industrial companies, and they're saying they still have supply challenges. So wages first.
Well, when you talk about wages, and again, thinking more about the consumer packaged companies, a lot of these companies, it's unionized. And so once labor contracts are negotiated, they're not going to go back down. They're only ever going to go up. And, you know, as coming out of the pandemic, there were a lot of negotiations with regards to the working conditions and the salaries and things like that. When it comes to the consumer, you know, wage growth has slowed a little in relative to inflation, at least. And so consumers are still in that spot where they're making selective decisions when they're purchasing, even on an everyday essential. It's a unique situation where labor, depending on which side you're on, is an issue.
Do you think companies the ones that had to do all of these higher wages because of unions, I think of UPS, but then had to lay off people, are going to have to make up with some of these wage gains with laying off other parts of their business?
Well, at least in my industries that I cover, they went through some large layoffs not that long before the pandemic. And so They are relatively lean at this point, but there will be a focus on cost cutting. Most of the time, that's going to be on internal things. And for the next year or two, the low-hanging fruit is really in bringing costs out of the supply chain. During the pandemic, because there was such an emphasis on just getting goods to be available for people, it added a lot of cost into supply chains across the board. So the low-hanging fruit for this year and maybe into a little bit into 2025 is how do you right-size your supply chain again and take the costs back out? That should help eliminate the need to do any kind of mass layoffs.
Jennifer Patashis of Bloomberg Intelligence. I'm sure we'll be catching up with you next week when we get Walmart and Home Depot earnings. Thank you for being with us today. If you are just joining us, just to recap what we just saw, inflation data coming in yet again hotter than expected, and this data goes directly into the Fed's core PCE deflator that they look at to really gauge out where inflation is. The response in markets has been the knee-jerk decline in bonds, the decline in stocks, decline of 0.2%. Not a lot of drama. We don't want to overstate it necessarily. In the S&P, 5,037. The Russell 2000, though, Manis, really taking a hit as it has been the hardest impacted by any potential increase in rates implied over the rest of this year.
Yeah, it's the torture of the value to growth proposition and the going for breadth. 10 basis points on two-year notes. We're trading at 467. I think you're at the start of the day, which is that's the highest so far this year. If you look at 10s, 430. Again, trapped in the upper echelons of this bandwidth between 375 and 430. And the natural question is, do you look at this as an opportunity to step in for duration, or do you run the risk that this is going to be a very stumbling, difficult road back to a more normal, the norm of inflation that the Fed want to see?
Inflation is highly political. And Anne-Marie, I'm sure we'll hear a lot of discussions about how the inflation genie hasn't gotten fully into the bottle and concerns from the political sphere. How do you message something as noisy and messy as disinflation?
It's very challenging for this administration. You see them try to say, look where we were during the depths of the pandemic and look where we are now. They're not going to want to focus on any specific report that we get. But obviously, when the economic data is noisy and the American people aren't feeling it, it's very hard to message that. So you've seen the administration go after corporations about greed, shrinkflation, but today, the Michigan survey. They have really been harping on this because the past two, the survey has been much better. And they're hoping that the American people are starting to feel some of the good data.
That's in part what they're banking on, isn't it? That whole sentiment.
Well, and that's directly tied as well to gasoline prices that have been the bright spot in a lot of the inflation reads that have otherwise come in hotter than expected. Here are the numbers if you are just joining. PPI, if you strip out food and energy, which have been the disinflationary types of trends recently, you see a 2% increase year over year versus the expectation of 1.6%. When you look month over month, the final demand headline figure, 0.3% versus the expectation of 0.1%. On Tuesday, we will continue to dig into this. Steve Chivarone of Federated Hermes, Sam Stovall of CFRA, BlackRock's Amanda Lynham, and Joe Feldman of Telsey Advisory. Manis, thank you so much for being with us.
It's been a pleasure.
And we will continue to parse through these inflationary figures. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women. Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change
hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City for our viewers worldwide, I'm Danny Berger in for Jonathan Farrow. Your last trading day and another disruptive piece of data. Too hot PPI sends yields backing up to their highest level of the year with stock futures lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
The latest inflation data coming in hot, sending futures lower and yields higher as traders start dialing back their rate cut bets yet again. We begin with the big issue, putting a bow on a busy week of economic data.
The confluence of data are all telling you this economy has more resilience. How much is reasonable to think about the Federal Reserve cutting interest rates? We began the year with the market anticipating 5. We pushed a little bit beyond that. The market's going to have to come into being bounded from below by 3. And then the question becomes, is it 3 or is it less than 3?
Let's get right into it. Joining us to discuss is Aberdeen's Luke Hickmore and BlackRock's Amanda Lynham. Great to speak with you both. So here's what we got about 30 minutes ago. PPI coming in at 0.9% year over year. The expectation was for 0.6%. Bond yields back up. We're looking at a gain of about 10 basis points on the front end. Luke, let me kick it off with you. We were able to look through that CPI data. We bounced back from that. We didn't seem to care about weak retail sales. Will the market be able to look through this latest round of too hot PPI data?
Probably. I know it's a bit hedging there, Danny, but every time we think we're at the end of the inflation run and it's come down to the point where the Fed can move, we get a surprise. In some ways, it's fairly normal. Inflation tends to do this after it's come off a big hike and it's come down a long way. We get these little ripples and waves of inflation coming back. So it may be still too early to tell, but I think over a medium to longer term, yes, we should look through it. By the end of 2025, we've probably got 2 percentage points off the Fed rate, and we may just be arguing about small things here, whether it's 3 or 4 this year. It may not matter by the time we get to the end of next year.
We go to the land of nitpicking, I guess, in that scenario. Amanda, what say you? Are we going to be able to look through this figure?
Good morning, Danny. Thank you for having me. I think to a certain extent, the market should stay attuned for real-time changes in the pattern. One of the key risks, I think, for risk assets is a sustained reacceleration in inflation. That's not our base case, but it's a risk that we're monitoring. I don't think we can extrapolate a few recent data points, specifically perhaps maybe the January data in the CPI print was impacted by seasonality. So I think we need to look, as Fed Speak has also alluded to, at the totality of the data
data and the mosaic of the data. That being said, the main takeaway from our perspective is that it emboldens the Fed's patient stance. And our base case remains for the first rate cut to happen in the second half of 2024. And I think the recent data from our perspective just removes a sense of urgency for swift, significant near-term rate cuts. And I think that's consistent with the data that we've seen this week, frankly.
Yeah, and Amanda, that completely lines up with what we heard from Bostic yesterday. But again, that was bad news for bonds when we heard that. Luke, if that's the drip feed we're going to get, and we're going to get into the central bank speak in a little bit, I know you like duration. You want to add, I mean, is this not a tough environment to be buying duration in if we're going to continue to get these blips and bumps along the way of inflation scares?
It's never easy when we come off such a big inflationary environment. I think we are getting to a point of more stable inflation and lower inflation. I think the Fed will move in this half of the year on the next half of the year, but ultimately it won't matter. I think we have to use these pullbacks to add duration, almost dollar cost averaging into your US Treasury portfolio. It's definitely not have no duration and add loads. It's a step by step by step by step. We're getting there. The Fed will get there too. Inflation will get there. And I think we'll all be in a good place by the end of the year.
Well, I'll tell you what, it's not that folks are adding duration right now, it's that they're adding risk. It's not even just stocks. It is remarkable to see what's happened to the credit market over the past week. Demand is insatiable. And on this, Bank of America is screaming bubble. They say nothing screams bubbly markets more than when corporate bonds start heading for the stratosphere. Amanda, they're basically saying that we're lurching from bubble to bubble, and the latest one is seen in incredibly tight spreads. Does this end in tears?
We don't see a bubble in the credit markets. And in fact, we have a pretty constructive view on credit risk here. I think one of the really important factors to keep in mind is that this backup in yields when and during the periods of time that we see it provides an opportunity for yield-based buyers to deploy capital at fairly attractive all-in yields. And so that in general has actually brought out a fair amount of demand from certain investor cohorts, even while spreads are somewhat snug on a historical basis. And on that spread point, actually, if you look just even back to mid-2021, there is a fair amount of scope for spreads to tighten even more. It sounds maybe a bit counterintuitive to say, but when you look at the index, even if you adjust it for dollar price and duration, we've been tighter than this not that long ago. The key will be, do we have a supportive growth inflation mix, and do we have a central bank in the Fed that is willing to cut rates proactively? But I don't view it as a hindrance for investors to put money to work in corporate credit. In fact, I think it's actually just the opposite. And what we've seen has been relative resilience in corporates' ability to navigate this higher cost of capital environment. That's true in public credit as well as in private debt. So I don't actually think that it's too much of a headwind. I think we have to pay attention to some of the nuances, and that maybe spreads look optically tight, but in reality, there are some nuances there where they could actually move tighter.
Right. Well, it certainly tells us, if anything, that there's a lot of liquidity sloshing around in the system. Luke, what do you think the impact of that exactly is?
Well, you've got two credit investors on today, but I don't agree at all. I think that liquidity is entirely what's been driving credit spreads tighter. It's not a change in the fundamentals. It's not the better background. It's not the cutting of interest rates or inflation. It's a massive amount of liquidity. The support for new deals, even in just the last week, has been extraordinary. And whether those deals are coming from corporates, banks, or governments, the amount of money that's sloshing into it is massive. Even Bitcoin ETF is taking money left, right, center. So whilst that continues, yes, credit spreads will continue to grind tighter, but it's going to get harder and harder and harder to see much of an impact from capital gains from credit getting tighter, and it becomes more of a carry story that you're just trying to get that incremental little bit of income, which is fine as long as everything stays stable. And that's the risk investors face. As you get tighter in credit spreads, you should be reducing your risk to them. That has always been the case, and I think it's probably the same now.
Well, some healthy disagreement, that's exactly what makes a market, and a market is going to be made next week with more Fed speak. We were talking about already hearing from Atlanta Fed President Raphael Bostic. I want to hear from the man himself. Here's what he had to say.
The evidence from data, our surveys, and our outreach says that victory is not clearly in hand and leaves me not yet comfortable that inflation is inexorably declining to our 2% objective. And that may be true for some time, even if the January Consumer Price Index report turns out to be an aberration.
Let's bring in Michael McKee to add to this conversation. Mike, we had Barkin speaking about an hour ago. Barr, I think, is speaking shortly, if not now. Daly speaks at noon, not to mention everything we're going to get next week. Do you expect the tone to sound a bit more like Bostic after this week's data?
I think so. I mean, what Raphael was able to do was tie in the data that we have gotten. Previous speakers from the Fed last week and this week have suggested also that they're ready to wait. I would add to his list of possible reasons for caution this Bloomberg chart. It shows what's happened with both CPI and PPI. They've come up a little bit, and on a year-over-year basis, the core numbers are flat. The progress we had seen halted, and of course, with retail sales on the bottom there, you can see that we went the other direction. Now, there may be excuses for all that, so we're going to have to continue to watch additional data, and next week we do get significant data. We'll get the Fed minutes. Now, that'll be 3 weeks old, but it may eliminate some of what they're thinking about in terms of what they want to see before they cut. Other than that, not a whole lot, except the income spending and the PCE inflation numbers, which is their index. Omar Sharif of Inflation Insights says the PPI today may push the month-over-month gain in the PCE to 0.4. That would be double last month and double expectations, and would not be good news for the idea of rate cuts. Who is going to be talking? Well, we got a whole host, 9 members of the Open Market Committee in the next 2 weeks before we get to the end of the month. The question is, will they say anything different, and will the markets really have something to move on when they are talking? I think they may not, and here's the reason why. We get Jay Powell. Yesterday it was announced he will give his semi-annual Humphrey Hawkins testimony on May 6th and May 7th. So we may not get any kind of definitive answers till we get through all of that data, and then we hear from the chairman. Now, we know he's not going to say March is on the table, but is he going to push back against May? Tune in.
Mike, as I said, Barr is just starting to speak. We're getting some lines crossing. The Fed's Barr saying that supervisors are closely focused on bank CRE loans. He's saying that the Fed is asking if banks are doing enough to brace for bad loans. Regulators have downgraded bank ratings at a faster pace. Mike, amid all of this, amid all the inflation, they are still focused on banks. It makes sense, of course, that Barr is. How much does that confuse their job going forward?
When you talk to them and when they talk in public, they're saying the banking system is sound and resilient. And Vice Chairman Barr's speech today is basically a look back at what happened with SVB and an outline of what the Fed has done since then. They've cracked down on some of the banks, and they've tightened their supervision, and they're trying to make sure that nobody gets as far offside as SVB did. At this point, their argument is nobody is in that kind of position. Of course, it's always what you don't know that matters.
Mike, thanks so much. That's Michael McKee. And Luke Hickmore and Amanda Lynham are still with us. Amanda, I have to follow up on these Barr lines saying that they're still closely focused on bank CRE loans. Have we seen the worst? Is it past us yet?
It's a great point, Danny. So CRE, in our view, is a highly dispersed asset class. The office sector has been in the headlines, of course, well telegraphed structural shifts there. But there are also other parts of CRE that are doing quite well. So that's certain subsets of industrial and self-storage and hotels, even some parts of multifamily. So that is a sector that we don't approach with a broad brush. I think the one takeaway that we do feel pretty confident about is that this is going to be a longer-term process. this in years past, and even in the experience following the financial crisis, which we're not at all making a distinction that we're in a similar environment. But in the financial crisis, that long-term kind of loss and default cycle and right-sizing of valuations took years. We expect a similar pattern to prevail this time around, just given some of the long-term nature of office leases, the fact that we need transactions to rebound in order to reset valuations. That's not going to be as quick of a process as you see, for example, in the corporate credit market when there's a default and that process moves much more in a speedy direction. So it's something that we think will be in the background for a while. I think the key for corporate credit investors is, does this remain, as Chair Powell and Secretary Yellen have recently said publicly, manageable and idiosyncratic to a group of banks, or does it become a widespread issue? It's not our base case that this becomes a widespread or systemic issue, but I do think that we should expect that price discovery process to continue. Unlike the credit market, where M&A strategic volumes have increased, we have not seen CRE volumes increase to the same extent, and so that will be a necessary ingredient for valuations to reset.
Right now, markets selling off small caps, which of course includes those regional banks, probably do more to the PPI than those lines from Barr. Luke, Amanda, stick with us. That's Luke Hickmore and Amanda Lynham. Joining us now to take a look at some of the stocks moving ahead of the opening bell is Abigail Doolittle. Abby.
Well, Danny, it's interesting because we have the U.S. futures, the S&P 500 futures, down ever so slightly, but bigger movers beneath the surface. Starting off with the shares of Coinbase, this stock is surging. The crypto exchange made a surprise return to not just profitability, but robust profitability. They put up $1 for an adjusted earnings versus the estimate of a penny. Sales were 15% better than expected. Jefferies is saying that the surge in retail is behind it. Others saying crypto prices. Either way, there is a 10% short interest, so some of this could be a squeeze. Super Microcomputer up 7% in the pre-market, heading to a potential 10th up day in a row. That would be the longest winning streak, at least since 2016, a record high going back all the way to 2007. Bank of America yesterday coming out and saying that even after the stock rose 900%, it can go higher yet. The RSI is extremely extended. FOMO, but the stock really is higher. And then Nike, not so much, down 1.2%. They're cutting 2% of their workforce. That should amount to about 1,600 people to save money. This, as growing consumer concerns, is weighing on sales, Danny.
Yeah, but you look at some of those good earnings, and perhaps that's why the overall index isn't doing as bad as you think it might after hot data. Abby, thank you so much. Coming up on the show, another day, another round of layoffs.
There absolutely are pockets of weakness out there. Look at the job losses, the miscellaneous job losses being announced practically on a constant basis every day. We're seeing little trickles.
Nike, just the latest, announcing it will cut 2% of its workforce. We're going to have more on the retail landscape next. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
There absolutely are pockets of weakness out there. Look at the job losses, the miscellaneous job losses being announced on practically on a constant basis every day. We're seeing little trickles. But then you get payrolls of 353, and you get 0.4% core, and you realize, well, the economy is still pretty hot.
The narrative of a resilient U.S. economy is being clouded by more and more layoffs. The latest job cuts coming to Nike, slashing 2% of its workforce, and writing in a statement, quote, "The actions put us in position to right-size our organization and go after our biggest growth opportunities." The latest developments set the stage for the next 2 weeks. We're going to get big box retailers starting to pump out quarterly results. Let's learn about it. Now we're joined by Bloomberg's Simone Foxman. Hi, Simone.
Hi, Danny. Yeah, so at the end, in its annual report, Nike said it employed about 84,000 people. Though it didn't name numbers in its statement yesterday, this is likely to affect about 1,700 people. These layoffs are going to begin on Friday and likely to last through the end of its second quarter in May. This really signifying some near-term struggles for the company. Weaker sales, growing competition, especially in its sportswear brands. Oppenheimer cutting its price target to $110 a share from $150 a share and downgrading to perform rating, saying there's not a quick fix to Nike's overall problems and looking for more sustained fundamental growth. But really, retailers have been all over the place. Home Depot, Walmart, yes, kicking off earnings for those big box next week. They've underperformed the market over the past year, but many of them are really hot on analysts' lists. In fact, there are no sell ratings for Walmart. We're looking for sustained same-store sales growth of about 3%, whereas Home Depot, the goal there is really to keep those same-store sales declines amid high interest rates and slowing building to about negative 3.6%. But some of the data that we're getting shows what Citi calls a really shaky start to 2024. That is going to be the key on analyst minds as they listen to some of these earnings calls starting next Tuesday with Home Depot and Walmart, Denny.
Simone, appreciate it. Bloomberg's Simone Foxman and Luke Hickmore and Amanda Lynham are still back with us. Luke, it is this drip feed. First it was the tech companies, now it is Nike. It does feel like a shift that companies are finally willing to let employees go. It's not the hoarding we knew of last year, but it doesn't seem to be filtering through to the headline level. What do you make of that?
It's difficult to square off, isn't it? The Fed Beige Book also pointed pockets of weakness coming through in all of this. And I guess if you've been putting wages up during 2022 and 23, which Nike almost certainly will have been doing, and a lot of people will have been doing, that's a nominal increase as well. And it stays there as inflation falls off and actually nominal growth falls off. You have to adjust your cost base for the new reality that we're in. And we're going to see it again and again and again. And I think that the problem with all of the unemployment and employment numbers is they could be so survey evidenced that actually the reality could take a little bit longer to come through. Maybe we're seeing that. But it's hard to fight against the moves that we have seen in non-farms.
Yeah, it's true. And Amanda, only a minute here, but do you expect some of these incremental moves from tech, from Nike to filter through at some point?
I think our base case is absolutely for an ongoing rebalancing in the labor market. But with the unemployment rate under 4% for close to 2 years and the jobs workers gap still skewing in terms of more demand than labor supply, I think for now it doesn't pose a significant downside risk to the economy. But I would expect an ongoing rebalancing as almost a necessary ingredient to cool some of that services inflation that we and market participants and presumably the Fed are very closely watching.
Luke, again, very quickly here, but does this also mean margin compression it is in and it is happening for companies if they're looking at cutting costs this way?
Yeah, it has to be. It has to be margin compression. You have to get on top of your costs in the environment we're in. Slow growth, lower nominal growth, cost.
Fair enough. That was very succinct, Luke. Appreciate it. That is Luke Hickmore and Amanda Lynham. We are seeing continuing selling off in these markets. The Russell 2000 down 1.5% after that hotter PPI data. The rest of this equity market, tech is even able to move higher, up about 0.1%. Well, coming up, we're going to get your morning calls, and later we're going to be talking with Talbakin's Michael Purvis on big tech's moment of truth. We have NVIDIA earnings hitting the tape next week. Will NVIDIA save us all after too hot inflation data? That conversation is coming up shortly. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. PPI comes in at 0.9% year over year. Estimate for 0.6. It is enough to pull equities back, at least this future session, from their highs of the year. We hit that record yet again yesterday. We're down by about 1/10. It's not a lot of drama. It's not too bad, but it is lower. Tech, though, that outperforms up 1/10. Maybe it's the solid earnings. Coinbase, Applied Materials, those hanging in. Finally, Russell 2000 futures. Here's the drama, if you want to find some. Down 1 1/3, matching some of the backup in rates that we're also seeing. The small caps, they want cuts. It doesn't seem like we're getting it. All right, time now for your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Oppenheimer downgrades Nike. Market perform, worried about U.S. consumer and weakening demand trends. Next up, Baird upgrades UPS to outperform, highlighting the stock's favorable risk reward. Finally, Raymond James downgrades Carvana to underperform, expecting limited upside following the stock's recent outperformance. Coming up, we have to brace ourselves for NVIDIA. Will the earnings on Wednesday make or break the rally in big tech? You saw it there. Tech seems not to be impacted by the hotter data. Futures in the NASDAQ up by 0.1%. We're going to have that conversation up next with Talbakin's Michael Purvis. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Difference a day makes. We were euphoric on weaker retail sales yesterday. Today it is a concentration on too hot PPI. The opening bell is now, you're looking at futures slightly lower. Not too bad. In tech, outperformance. Are we still impervious to hotter PPI, to hotter CPI? Russell 2000 futures certainly aren't. We're down 1.2%. The drama perhaps is in yields. Let me show you what this bond market is doing, because at least for the front end of the curve, we are up higher at the highest level for this year in rates. The 10-year yield backs off the worst of the losses we've seen. Yields are up about 8.5 basis points. NY crude adds on to yesterday's gain of 1.5%. We're up 0.5%, just under $79 a barrel. Euro weakens versus the dollar. It is that hot data that's sending the dollar higher. It's a repeat of Wednesday, folks, when that CPI data sent the euro to year-to-date lows. We're staring down the same. 107 is where we stand. Now, one stock to watch at this open, it is Nike. They're implementing new cost control measures, reducing its workforce by 2% amid growing competition. Bloomberg's Abigail Doolittle has more. Abby.
Well, Danny, let's start with this fact. This stock is down about 40% from its 2021 high. So clearly shareholders want something done. Management wants something done. Growth has dropped with that drop in the stock. I should actually say that the drop in growth has driven the drop in stock. Sales in the last fiscal year up 5% versus up 19% in 2021. From an earnings standpoint, it's even worse. Growth has been negative over the last 2 years versus up pretty solidly back in 2021. So they're talking about a super lumpy business. It even just shows up in the financials. They're also saying that they're seeing caution on the part of the consumer. So to your point, they're looking to cost cutting in terms of simplifying their own operations. In addition to that 2% cut of the workforce, or about 1,600 to 1,700 people, 2 waves. The first today, probably not an easy feeling for those more than 80,000 employees around the world. It could equal about $2 billion in savings. Oppenheimer, though, Danny, not so impressed. They have cut the stock to a perform from an outperform, saying there is no quote-unquote quick fix for Nike.
As Luke Hickmore was saying, the margin pressure, it is in. Abigail, thank you so much. Now, other earnings, Roku shares are plunging after its first quarter profit fell short of analyst expectations. Bloomberg's Simone Foxman has more. Simone.
Yeah, the company reporting results after the bell yesterday, and the market really not impressed despite some positives here. Let me start with those. Fourth quarter EPS were in line with analyst expectations at a loss of 55 cents a share. And we got actually better than the street was expecting in terms of the revenue front, 14% year-on-year growth at $984 million. Active customer accounts also up 14% year-on-year, but there was one data point that has been really troubling for analysts, and that is average revenue per user. That was under anticipated, and it was down 4.2% year on year, suggesting that ads just simply not as profitable as we get more competition in this online streaming space. Stevens saying Roku continues to call out an unfavorable macro environment in the near term, an uneven ad market recovery. Oppenheimer says it doesn't see the stock going anywhere until it gets sustainable high teens revenue growth. This has been a tough week for Roku as well, because Walmart, there were reports that Walmart may be buying Vizio. That means a potential expansion by Walmart as well into this ads and streaming space. Broadly, this stock is down over 80% from hitting a high in July 2021, and of course down nearly 20% today, Danny.
Yeah, that is painful at its lowest since 2023. Simone, thanks for breaking it down. Now let's stick with earnings, because on the good side of things, we need some good news today. Shares of Applied Materials hit a fresh intraday record high after delivering a bullish outlook. Bloomberg's Isabel Lee joins us for more. Isabel, are the chip makers or the makers of the chip makers back?
They are back, and this is the much-needed good news. You're right, shares are up around 8%, and it's really the bullish revenue forecast that got investors excited, because this means that some of the biggest semiconductor companies are increasing their investments in new products. That, and that the chip industry may just be bouncing back faster than expected. We have fiscal second quarter sales around $6.5 billion. That's higher than estimates. And excluding some items, profits will be $1.79 to $2.15. That's the average. That's the low end of the average projection. So Applied Materials supplies gear to a lot of the big sector's major manufacturers. That includes Samsung, Taiwan Semiconductor, and Intel, which is why this makes the company's projections an indicator of future confidence when it comes to key demands of the electronic supply chain. And we also have sales slipping, but still higher than expected. And China was a bright spot. We saw sales more than doubling and now accounting for 45% of the total of the company. And demand for chips has been growing because, as you know, more and more devices are becoming more complex and more complicated, and they demand now more computing capacity and the ability to sense the world around them. So that's one thing for those who are into high-tech stuff. For now, shares are up around 9%.
Who among us aren't into high-tech stuff? Isabel, appreciate it. Isabel Lee. Let's turn to the other tech stuff. Bloomberg is reporting that Apple is developing a new AI tool to compete with its rival Microsoft. Bloomberg's Ed Ludlow is in San Francisco. Ed, I feel like I woke up to maybe 10 different headlines about different AI competition. What's Apple doing here?
Not very much, to be honest with you. If you look at the stock, we're higher a tenth of 1%. By the way, I'm into that high-tech stuff.
Love it.
But this is an important report from Bloomberg's Mark Gurman, because Apple has not really shown its hand to the extent that Amazon, specifically Microsoft and Alphabet, have on consumer-facing AI tools. What he's reporting is that they're working on an add to Xcode, which is their program writing platform for app developers, where it will have a generative AI capability, something akin to Microsoft's GitHub Copilot. It's a predictive tool where if you're writing code, you're a software engineer, it helps you complete that code. It's basically more time efficient. It's a very useful tool to have. And what sources are telling us is that within Apple, having presented some of the work that they did on AI to the board at the end of last year, they're doing what's called dog fooding, which is using all of these AI tools internally before a wider rollout to third-party developers. So this isn't kind of the sexy generative AI ChatGPT tool that a consumer can get their hands on immediately. But the other side of the coin is Apple's always been flexing that it is kind of focused on machine learning and has been for a long time. All the other names out there, I point you towards Alphabet, parent of Google. It's softer by a tenth of 1% now, a really big decline Thursday. The Information reported that OpenAI is working on its own search, powered by Microsoft's Bing, and that seemed to have a substantive and direct causal effect on Alphabet shares, though every investor that I speak to says, don't do anything knee-jerk. It's going to take something very significant to knock Alphabet or Google off the search perch God, it's a lot for a Friday. Happy Friday, Danny.
Happy Friday, Ed. And we love an underdog story. Justice for Bing. Ed, thanks so much. And you might have seen at the bottom of your screen there, Super Microcomputer still up 7% today. Tune in to Ed's interview with the CEO of the company. That is at 11 a.m. Eastern. Now let's stick with tech because it's the one everybody's waiting for. NVIDIA results sparked a monster rally in big tech last year, and that has investors bracing for yet another critical report next week. Take a listen.
I do think the sky's the limit. This is the third time in my career, I'm now 45, where I think I've seen something that is going to have a before and after epochal change. So internet, CRISPR, and now AI. I think that the AI movement will have at least as big an economic GDP impact as the internet has, maybe greater. And so does that translate into an ever-growing stock price? That I can't say.
The sky's the limit. The hype is ever real. Let's continue the conversation now with Telbakin's Michael Purvis. Michael, here we are in the world. It's all calm in the VIX. We've been under 20% for about 4 months. And then I look at the options buildup in NVIDIA with implied volatility on their earnings around 11%. Do I need to be thinking about Wednesday as not just NVIDIA earnings, but also a day of a potential volatility event?
Well, it's interesting you bring that up because there's even a bump in the SPX volatility for the, in other words, a premium for SPX options on the NVIDIA announcement. And I think it's a little bit of a metaphor for how important NVIDIA's earnings are for this overall trajectory of this stock market right now. One of the things I've certainly been very focused on is the how low correlation across stocks have been. And one way to think about that is just there's not a lot of macro priced into single stock options right now, which is arguably a sign of too much optimism, I think, at sort of creeping in. Ironically, it may be a single stock earnings release next week that if they do disappoint, or or at least don't exceed expectations, that might be the actual kind of sort of quasi macro event that actually drives correlations across stocks higher. It's a very unusual condition but let's face it, NVIDIA was the anchor of the big tech rally last year, and big tech was the anchor of the broader stock market rally, and that continues to be the case this year. Valuations have been stretched. They've done a masterful job of producing earnings growth last year there, but if they, at this stage, I think if they do underperform, it will be a volatility event, for the broader market.
Well, on that note, Michael, I was reading your note from earlier this week, and this stood out to me when you wrote that a variety of volatility metrics are eerily similar to January 2018, just before the manic VIX surge a couple of weeks later. We are not saying this will be happening this week or next week, but we are saying there is plenty of gunpowder and plenty of matches lying around close by. If you want to lose some sleep tonight, that's a good note for all of our viewers to read, Michael. I mean, could this be it? Could bad NVIDIA earnings be the match lit?
That's one of the potential catalysts. It could be more economic data that affirms that we're not going to get rate cuts anytime soon. Could be a geopolitical event. You just never really know. But what you do know on the sort of the gunpowder side, if you will, to torture this metaphor, is that there's been various facets of short volatility trades that have been working, that have been put on, and sort of it feels like an increasing scale there into a stock market that has done extraordinarily well. And so if you think back to the Volmageddon of February of 2018, that was when the XIV ETF, sort of a short VIX ETF, famously, just blew up and, yanked the VIX up from very low numbers to I think as high as 50. And of course that rippled through to equities and gave everyone a little bit of agita, regardless of what you were investing in at the time there. And I think there's a lot of similarities between now. Like, if you look back at 2017, you had a strong rally, you had a lot of divergence led by tech in that year, same thing like last year, and so forth. If you look at implied correlations now, they're basically where they were back then there. And too much of a short volatility trade just at some point engenders, a big volatility spike. there. It doesn't mean that and it really doesn't have to be bad, anything bad fundamentally in the economy or anything like that. It could just be something that gets the market to say, wait a second, we're not going to keep buying this dip, realize volatility picks up, and then that triggers a bunch of closing out of short volatility trades that process is inherently a convex process.
Right. Well, Michael, because I remember
higher.
when that 2018 Volmageddon VIX blow up happened, and at the time I'd spoke to a tiny little fund in Colorado that was going long volatility because they thought that would happen. They got something like an 8,600% profit, I think, on it. If you're saying the market structure is set up that way, should I be punting on that type of options trade, getting ready for an explosion in volatility?
Yeah, well, I think you've seen VIX call buying pick up over the last few weeks there, and I think that's certainly a trade I've been recommending to my clients earlier this year. I think if you look at the VIX, it's sort of cautiously making a series of higher lows and higher highs. They're nothing dramatic yet, but it feels like things are building here. And, it's funny, you look at basically economic conditions are good, earnings are reasonably good here. But let's face it, valuation has been stretched. I think it's important to remember that the stock market rally last year started with AI. It also started with a massive amounts of offsides positioning.
Right.
And, just for context, more than half of last year's 24% rally came in November and December. And I think a lot of this momentum you've seen carry over into January and February can still be explained a little bit by some positioning catch
but
up
Michael,
there.
I mean, can it be more than positioning? We only have a minute here, so I got to jump in. I mean, earnings have been good. The economic data, okay, hot, but not that bad. I mean, aren't things good enough to just continue the rally?
Well, yes. Like you could check all the boxes you'd want for in terms of a lot of the fundamentals and the momentum and so forth. And yes, and the rate, I do think rates are going to keep climbing higher here. And I don't think that has to be, the death knell in and of itself. But look, you can go through a lot of great bull trends against good economic and earnings backdrops, and you do see big volatility spikes here. I'm constructive on the broader market this year and on the broader economy, without question. There, but I think after such a sort of tireless rally, a relentless rally, it was such a smothering of correlations across stocks and a lot of evidence that this sort of short volatility trade has been put on. I think we should be bracing for something at some point soon. And again, it doesn't mean that the fundamentals suddenly are broken. It just means that there's too much too fast. And I think VIX calls are probably a better trade than SPY puts in that respect. I just think
another
there's better risk return.
Volmageddon would certainly be a way to wake us all up from our slumber. Michael, we're going to have to leave it there. Thanks for joining us. Michael Purvis of Telback at Capital Advisors. Coming up, Republicans talk tough as a government shutdown looms.
You're not going to get another continuing resolution out of our conference in Congress.
We'll get the latest on the budget talks or lack thereof next. This is Bloomberg.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
You're not going to get another continuing resolution out of our conference in Congress. The last one was difficult, and that was done because our speaker recognized that there just wasn't enough physical time to process all the bills once the House and the Senate had agreed on the top line numbers. So this time you're going to have to get these things passed.
Republican Representative Tom Immerse saying the House will not pass another stopgap spending bill by March 1st, the latest deadline for a partial government shutdown. The House is on recess until Feb 28th, and that leaves very little time for negotiations. Bloomberg's Anne-Marie Hordern joins us now. Anne-Marie, does this mean we're going to have to do the whole song and dance again?
Yeah, multiple times we've had to do this song and dance. But let's first say that what we heard from the majority whip there is that he's saying there's going to be no continuing resolution. We've also heard this in the past from Speaker Johnson, and then in the end, we've had continuing resolutions. What makes this so difficult is the timing. So the House has already left, as you mentioned, Danny. They left yesterday, and they're not back till the end of February 28th. And the first deadline for the first tranche of a government shutdown is March 1st, the second then coming March 8th. So there's a wide swath of the government they'd have to be able to fund by March 1st. So that gives them about 3 days to get it done. And that is why everyone is shrugging this off and saying, you're going to have to do some sort of continuing resolution, kick the can down the road, or we're going to end up in a government shutdown.
Anne-Marie, we also learned earlier this morning that Alexei Navalny, one of Putin's most outspoken critics who had been jailed since 2021, has died, according to the prison service. Does this change the conversation in D.C. at all?
I think it's a question of whether or not this puts more impetus on Congress to get that foreign aid bill done, because Ukraine is obviously one of the big winners in that aid bill. A number of weapons that would go through the U.S. industrial complex would then be shifted over to Ukraine. And what the White House's response is going to be, they're going to want to punish Putin for this, but already we see the Russian economy have a number of sanctions and penalties against this. We should note what Secretary Blinken had to say about this when he heard the news. He said for more than a decade, the Russian government and Putin personally persecuted, poisoned, and imprisoned Alexei Navalny. His death in a Russian prison and the fixation and fear of one man only underscores the weakness and rot at the heart of the system that Putin has built. Russia is responsible for this. That is the line from the administration.
It's very strong language, and yes, do they back that up with aid passed to Ukraine? Anne-Marie, thank you very much. That is Bloomberg's Anne-Marie Hordern. Okay, let's get you up to speed on some of the sector price action this morning. Let's get over to Bloomberg's Abigail Doolittle. Abby.
Well, we are, Danny, at this point taking a look at a very small decline for the S&P 500, down about 0.3%. Materials, the only sector higher, up 0.7%. So broad participation to the downside, led by real estate, down 1.2%. Communication services down more than 1%. On the week, let's take a look at what is happening for the S&P 500 in terms of the top sectors and the bottom sectors. So two of the best sectors, energy and materials clearly getting a boost today for sure. And then on the bottom, you can see that consumer discretionary down 1%. We also have tech down 1.8%, and that is the reason why we're looking at a decline, the first in a little while, Danny, of about 0.2%. So today's trading action is really going to decide whether or not we see a gain or a decline for the S&P 500.
Yeah, do we finally see the cracks in big tech after that hot figure? Abby, thanks so much. Abigail Doolittle there. Coming up, the market-moving events that you need to be watching for your Friday trading day. That's next in our trading diary. This is Bloomberg.
I'm relieved that at the very least the situation between China and the U.S. Is calming down, and at this stage we just don't need something else coming for sure.
Are you confident actually that the U.S.-China relationship will get better?
No, I'm not confident because I'm not in control of that. But what I know is that the world cannot afford an escalation, and most likely both countries cannot really afford some things to escalate in terms of economic consequences. I mean, the situation in both countries is fragile, and I guess a geopolitical escalation is not going to be in the interest of both countries.
On Wednesday, but are we going to be able to bounce back from the hot PPI? Look at what tech is doing, down 0.8%. It is the Mag 7 that is getting hurt this morning. Meta down by 2.25%, but of course, Russell 2000. If we're not going to get cuts anytime soon, this thing gets clobbered down by 1 1/3. Bond yields, those are backing up. Rates are moving higher this morning. Front end leading those declines. We're up about 8 basis points, trading just off the highs of the year. All right, time now for your trading diary. Here's what you need to be watching through this day and next week. The UMich Sentiment Survey comes at the top of the hour. Then San Francisco Fed President Mary Daly will speak shortly after noon Eastern. Next Monday, U.S. markets are closed for President's Day. Tuesday, we're going to get earnings from Walmart and Home Depot. Finally, on Wednesday, it's NVIDIA's turn to report. We were just speaking with Michael Purvis, who says that it could be a volatility event for this market if it disappoints, that there's so much option buildup around NVIDIA. If it goes wrong, brace yourselves for a Volmageddon 2.0. In the meantime, we are seeing volatility today. Your VIX is up about to 14.5%, still under 20, so nothing that consequential. But Mag 7 sells off again. That hit to Meta, pretty significant. All right, that does it for us here. That was the countdown to the open. This is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com. Check us out. This is Bloomberg Intelligence. Alex Steele, Paul Sweeney with you here. Bloomberg Intelligence, 400 research analysts around the world covering a couple thousand stocks, maybe 130 industries, equity, fixed income. We tap into their expertise over the next couple hours as we look at the markets, as we look at individual companies. Coming up, we're going to take a look at that housing data. Came in weaker than expected here, so we'll check in with Drew Redding. He covers all the housing and the home builder companies for Bloomberg Intelligence. Will join us. Steve Steinauer, Chairman, President, and Chief Executive Officer of Huntington Bank, will come in with his market call. And coming up in the next hour, we got a couple of cool simulcasts with radio, television. Super Micro Computer CEO Charles Lang will join us as well. And then DraftKings Chairman, CEO, and co-founder, he's going to join us and talk to us about the gaming business, sports betting business. So that's coming up at the 11 o'clock hour. Lots of good stuff here. Let's kick it all off with Mr. John Tucker of the Bloomberg Business Flash.
All right, we are data dependent, but first, let's tell you, we're brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. University of Michigan Sentiment Survey coming in a little higher than expectations, coming in at 80. Coming in a little below expectations, 79.6. Let me clean the fog off my glasses. The expectation was for 80.
Sure.
Now, the inflation expectations, I always argue this is the more important part. One-year inflation expectations coming in at 3%, so that's higher than expectations of 2.9. The 5 to 10-year outlook for inflation coming in, again, a little higher than expectations, 2.9. The expectation was for 2.8. The 2-year yield in response to this, up right now 8 basis points. That's at 465. That's actually unchanged from where it was before when we got the earlier data. Prices paid to U.S. producers rising in January by more than forecast. Applied Materials, also the best performing stock of the S&P 500 right now. The largest maker of chip-making machinery issuing a strong forecast for the current quarter. And Amy Wu Silverman over at RBC Capital Markets says you can't count out momentum as a pretty big factor for the recent rally in stocks.
It's actually the momentum factor itself that's rallying. You know, this is what Q's is a proxy for. This is what Pickup Tech is a proxy for. But in reality, it's really just the momentum factor begetting more momentum factor. And when you get into these spirals, it takes a while for it to peter out.
Some petering out right now. The S&P 500, 22 points lower. That's down 0.5%. We are above 5,000, though, 5,007 on the index. The Dow Jones Industrial Average, 113 points lower. That's down 0.3%. The NASDAQ 100 down 162 points, and that is down 0.9%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
Thank you so much.
Happy Friday.
Yeah.
Happy Friday, guys.
I know. For a Friday, we got a lot of economic data here today.
I know, but I find it a little boring. Is that bad?
Well,
I just feel like after Tuesday, this wasn't necessarily a big surprise for me.
I guess, yeah, you're right. But the that PPI came in higher than expected across the board. And then, as John was just reporting, the Immerse data is a little bit weaker than expected. And we spoke to a lot of smart people on surveillance this morning, and I think the consensus was this is not, at this stage, probably a little too early to say that this is a reacceleration of inflation.
Right.
This might be more a month-specific issue. So
We'll say
see how
the
that plays
last mile is a little difficult.
Yes.
Which is just exactly what all the Fed officials have been saying. They're like, give us time. Just because it's not at 2 doesn't mean we won't cut, but like give us a little bit of time. I also did just say that we're headed into a long weekend, right? So maybe the buy the dip scenario won't necessarily last today, but you know.
Nobody's going to hold a
Buy the dip
position over
futures
a
Tuesday.
long weekend? Is that it?
I guess, yeah.
You know who's going to know about this? Abigail.
Really?
Yeah, let's go to Abigail Doolittle. She covers all the markets for us here at Bloomberg News Markets Reporter. Abigail, is it going to be a buy the dip again today or no?
Yeah, I think that since we're seeing the selling at least right now, the bit of weakness, I think you make a great point in terms of the long weekend, the uncertainty on so many different levels. And, you know, now we're starting to have inflationary data. I know that this is not like a genius idea that's been mentioned all morning, but we're now starting to have inflationary data that's confirming each other that we are not past it. So that the Fed's fears, what they've telegraphed in terms of not wanting to repeat the 70s or the early 80s, and that's why they're going to stay higher for longer, that there's an actual reason for it. So right now we have the S&P 500 down 0.4%, the NASDAQ 100 down 0.8%. Russell 2000 this week's really just been absolutely wild. Below the 50-day moving average on Tuesday, sell-off, back above it, now back down 1.1%, still above that level. But yeah, lots of volatility. You know, I was just looking at some superlatives, and we have the Bloomberg Dollar Index up for a 7th week in a row. And I'm trying to.
You haven't seen that since September.
Yeah,
That's
so
like
I mean,
it's
what's interesting though is we've had the dollar rise, we've also had stocks rise, which that's a sign of a healthy situation. That's basically what you ideally want to see: strong dollar, strong stocks. It's going to be, it's interesting to see that. I think that right now, technicals are just super interesting because the technicals from this week for the charts, it just looks very extreme, very choppy, pointing to the possibility of a bigger move, directional move ahead. When you start to see some real intraday and daily chop, it usually transpires into something bigger.
And I guess, you know, I'm looking at the, you know, the WERP function. The market's kind of pushing that rate cut out. I mean, I think, you know, June is probably more in the discussion than it was maybe a week ago.
Yeah, and swaps are saying July. So bond traders, once again, getting it wrong, making a bet in one direction, then having to course correct. If they had just listened to the Fed, they could have not had to make, you know, all of these whipsaws. Right now, we're looking at that 2-year yield at 4.65, the 10-year yield at 4.30. So that's the story. How much higher are we going to go? Is that 2-year yield going to go? Are we going to see 5% again? If we see 5% again, I think that the concern there is, okay, the Fed has a lot more work to do, that it's not a one and done kind of race against inflation, and that if that kind of liquidity comes out of the system or stays out of the system, that it could be a little bit tougher for some of the risk assets.
Meanwhile, side note, one of the best performing stocks in the S&P, Bio-Rad.
Really?
Yeah. It's
Never even heard of it.
It operates a chain of laboratories. So it's like life sciences and diagnostics, and it reported earnings. And all I think is like, that's just the coolest bio-rad.
Bio-rad.
Like, that just, it's like a little bit of
Tom
CVS
Keene
and bio.
was making a point this morning. He's surprised the market didn't sell off more today on this PPI data because it really takes, for a lot of folks, May is now off the table for some people, maybe.
But that brings the technical part in, I wonder, because we filled that gap right from Tuesday.
We did.
So therefore, I wonder if that also sort of helped support into this move.
I don't know if it's,